the meeting of the Investment Committee is now being recorded for record-keeping purposes. By participating in this session, you are consenting to the recording, retention, and future viewing of this meeting. This meeting is now being live streamed. Please proceed. Thank you.
Great, thank you. Good morning, everyone. I'd like to call to order this December 7, 2021 meeting of the Investment Committee of the Pennsylvania State Employees Retirement System. May we have a roll call, please? I think, Bill, you're going to do that?
Yes, thank you. Good morning, everyone. Chairman Becker.
Here.
Senator DeSanto.
Present.
Stillman.
Present.
Representative Frankel. Designee Mr. Acco.
Designee Representative Frankel intending to participate, but
I'm not sure we heard what you said, Dan. Could you repeat, please?
I said I'm trying to outage it, so I'll wait until.
Okay, so I believe he said he will be sitting for Representative Frankel for a while.
Okay. All right, thank you. Treasurer Garrity. Senator Hughes.
Tony Marchowski here for Senator Hughes.
Thank you, Ms. Marchowski. Mr. Jordan.
Here.
Representative Schemmel.
Here.
Harry Thal.
Greg Thal is here.
Secretary Vague.
Hi, Bill. This is Alan Flanagan sitting in for Secretary Vague.
All right, thank you.
I believe you missed Mary Soderberg.
Ms. Soderberg.
I'm here.
We have 11 present there, Chairman Becker.
Okay, good. Thank you very much, Bill. The first order of business will be the approval of the minutes of the September 28, 2021 meeting of the Investment Committee. May I have a motion, please?
So moved.
May I have a second?
Second.
Thank you. All in favor, aye? Aye.
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 Opposed, no. Hearing none, the motion passes. Old business, we have none to discuss today. We'll move on to new business. We do have several items under new business. The investment office will have some announcements and introductions to make. We have an update on our rebalancing of the portfolio, quarterly investment performance analysis for the defined benefit, defined contribution, and deferred compensation plans. We'll have a private market pacing update and presentations on 4 private market opportunities, and then brief updates on several investment office items. So with that, I'd like to turn it over to our CIO, Jim Nolan, and the investment office team.
Thanks, Mr. Becker. Just checking, can you hear me all clearly? Is that all good?
Yes, sir.
Bills are coming through out there?
Yes, sir. We can hear you.
Very good. Thank you. Thanks, Mr. Becker. Yes, as the chairman just said, we have some announcements from a staffing perspective. Just wanted to make sure the entire board, some of the board members know, but we have had a couple of promotions and a couple of new additions to the investment office, making progress on that front. Happy to announce. Many of you saw Meredith Jones at the last board meeting covering some material with regard to our corporate governance and ESG initiatives. So Meredith Jones has recently been promoted to Director of Corporate Governance, ESG and Diversity here within the investment office. So we're happy for that. Welcome Meredith to her new role. Bill Trong, who just did the roll call, many of you know, has been promoted to the Deputy Chief Investment Officer. So looking forward to Bill continuing to bring his depth of knowledge on investments and to serve organization to the board on a regular basis. On the new hire front, over in Jeff Meyer's area, our Managing Director of Operations, we have recruited from Mr. Marcucci's staff. Sorry about that, Joe, but she's still with the organization. It's good news. Britt Ernie has joined the investment office. She'll be reporting into Meredith Jones, working in that role of corporate governance, ESG, and diversity, as well as other topics and items in the operations area. And then 2 new recruits have joined. Kirk Hevner, who's come in from BNY. He's had a number of years with our custodian. So he brings a wealth of knowledge to that area for the operations team. And then after a 6-year stint with the U.S. Navy, Fred Wilson has decided to come into the public plan world, finish his degree at San Diego State, where he was last stationed. And he joins us again in the investment operations as a junior investment analyst trainee. So those are the updates, Mr. Becker, on the staff. Would you like me to proceed on to the first item? Okay, the first item, as Glenn mentioned, under 5A in board docs, is the rebalancing recap. We had 2 transactions since the last board meeting because of a couple of reasons. One, we moved a major asset in the asset allocation into the opportunistic fixed income bucket, which gave rise to an overweight in fixed income and underweight in equity. During September, the equity markets were weak, down about 1%, or sorry, down 4% or so. So that was an opportune time to rebalance our equity exposure up to target at the expense of fixed income, and that was taken care of in a transaction that's covered in the slides that are being shown on the display now. Katie, do you have maybe advance to page 6, please? And that's just a recap of the assets that were moved before and after. Moving on to October, if you could advance to page 11, equity markets had a spectacular run of almost 7%. So our equity exposure actually ended up getting a little bit above weight, and we went ahead and rebalanced that back to target. And then all the while with these transactions were going on, we're projecting the future of benefit payment requirements to make sure we had no disruptions and didn't have to do a transaction, a forced transaction right up against the benefit payments which occur at the end of the month. So that was all planned into the analysis, and these 2 transactions were completed. And that's there for your information if there's any questions on that at this juncture. Okay, if not, next we'd like to move to 5B in board docs. Those are our quarterly performance reports. And Katie, if you could pull up the DB plan executive summary first. On there, Tom Shingler and his team will be going through this performance report, but I wanted to just flip to page 15 for just a minute to highlight some spectacular news. When I joined CSRS 6 years ago, we had been pretty much operating, our performance had been coming in at a median return level. Some periods a little above, a little below. But since we've made a number of changes over the years, and I think they're starting to show up in the numbers, and these various time buckets that are showing on the display, you can see the blue dot, that's the total fund performance. We won't go through all these individually, but just want to point out that over the last 3 years, we've been generating above top quartile performance and have been above median in almost all the periods. So that's I just think it's very, very exciting to look at that and see the performance coming through after a lot of hard work that's been done. A lot of discussions have taken place in this boardroom and a lot of presentations have been made, but it seems to be coming through. So if you, Katie, could take it back to the beginning, and I'll hand it over to Tom Schindler from Callan.
Okay, thank you. Good morning, everyone. I hope everyone's doing well and wish everyone a safe and happy holiday season. So if we can go to the next slide, please. I'm going to briefly cover the market. So I think there's, if someone can mute that's unmuted. Thank you. So if we could go to the next slide, please. Keep going. Thank you. So this is showing the performance for the last quarter and then also out to longer periods. And this was a muted quarter for the overall markets as well as for our general plan sponsor universe of clients. So in the median public fund return was just a little bit above zero on the chart Jim showed for the quarter, and then public market equivalent of global stocks and bonds was actually negative 0.63%. So it was a very muted quarter. We're actually coming off, if we go back to the period ended June 30th, 2021, that was an extremely strong period for markets coming out of the COVID bear market in 2020 and then the recovery out of that. So for the fiscal year ended June 30, that was the strongest year we've seen for public market returns and for public fund returns in particular since 1985. So extremely strong returns for public funds, including SIRS, and a much more muted recent quarter. And that does reflect the fact that we had the surge related to the Delta variant and a lot of issues related to the supply chain and inflationary pressures. So it was a muted quarter in terms of economic activity in the U.S. in particular, with GDP growth still positive, but dropping sharply to 2%. So you can look at these returns here for the quarter, see that U.S. equities was mildly negative, 10 basis points. Non-U.S. equities were also negative, whether it was developed or emerging markets, and fixed income was just a little bit above zero. The outliers are in the private markets, so real estate, strong recovery there. The property index was up over 5%. And then in alternatives, so specifically private equity with very strong returns. I will note that that's a quarter lag, so that's actually showing performance as of 6/30. If we go to the next slide, and one more, please. So we have seen inflationary pressures in the United States and around the world. There's been a lot of talk about the term transitory for inflation, that it's not something that's going to last. It's related to a recovery in economic activity coming out of the worst of the pandemic. But that language has changed from the Fed in the United States because the inflationary pressures have continued. So the Fed has backed off of that language of calling it transitory. I think it's a vague term to begin with. What does transitory mean? To one person, it could mean 1, 2, 3 months. To someone else, it could mean 1 or 2 years. So the Fed is acknowledging that these inflationary pressures are more sustained than they originally thought. The last readings for inflation in the U.S. are north of 6% or north of 4% for the major consumer price index, depending on whether or not you take out food and energy. So either way, inflation is much above the Fed's 2% target. And there's been certain areas where we've seen really strong inflationary pressures. If you've tried to buy a new or used car in the last year, it's been very apparent. But now we're seeing inflationary pressures that are more broad-based, that include areas like energy, food, activities out of the home, like away from home lodging, airline tickets. The inflationary pressures are more broad-based, And we could see the Fed act in response to that more quickly. They're probably going to taper. What does that mean? It means they've been purchasing bonds, and they'll that is supposed to drive down long-term interest rates. They are intending likely to increase the pace at which they stop doing that to combat those inflationary pressures, and then also maybe raising rates sooner than we thought because of, again, trying to combat those inflationary pressures that we see. So it's definitely a difficult spot for the Fed, where we're trying to continue this economic recovery in the U.S., continue with job growth, but also fight high inflation. So we are monitoring that, and we expect more comments coming out of the Fed next week. So if we keep going from here, could you move on, please? Thank you. One more. So I briefly want to cover China. It's been in the news a lot. It's important to understand this in context of global markets. So China is a really big part of the emerging markets stock market. If we look at the main index for emerging market stocks, China's about a third of that universe of stocks. If we look at global markets that include the United States, developed non-US markets, and emerging markets, it's actually less than 4%. So in the emerging markets specifically, they're a very big part of the markets, but as a part of global markets, they are much smaller. Of course, in terms of an economy, they're very large, one of the largest in the world. So what happens in China does have a global impact. A couple of key points here. One is that from an investment perspective, and this does speak to the importance of active management in China, we are seeing more market interference with private sector companies by the Chinese government. China has been a driver of returns in emerging markets. That's what we're trying to show on the top chart. But the path forward, we do expect to be different because of more interference from the Chinese government. And then from an economic perspective of what's going on in real estate, and particularly with the company Evergrande, you can see that on this bottom chart, real estate's a very big part of the Chinese economy. It's almost 30% of GDP, real estate related activity. So what happens in real estate does have a broad impact there. And that's an area where we could see a combination of support from China in certain areas, and as well as letting companies like Evergrande potentially fail. They actually just missed another interest payment. So there is expected to be fallout in China from that as well, in terms of the default of Evergrande. But also keep in mind that this has been a situation that's been ongoing for months now, and it's already been reflected in prices of stocks and bonds that have an impact from Evergrande. So that's a brief update on what's going on in China. If we move on from there, I'm going to get more specifically into the SIRS plan in the interest of time. So if we keep moving, please. Thank you. Keep going. So if we go one more slide, this shows the asset allocation of SIRS plan versus the target. And keep in mind that the asset allocation did change in the spring. There was a slight increase in the U.S. equity allocation, a reduction in private equity. That was with the proposed introduction of microcap. And then when we met in the summer at the end of July, there was a more significant change to the asset allocation, where the overall equity allocation was increased and the fixed income allocation was reduced to have a higher expected risk and return to the portfolio. So this actual allocation and target is as of the 9/30. Will, with the coming quarter, update the target to the new target that was adopted over the summer, and the rebalancing that Jim just covered that's been done to address that new target. So this is in a flux state. What we're seeing here is a snapshot in time as of 9/30. If we move to the next slide, it puts it in a little bit more context of return seeking versus capital preservation. This is one way of looking at the asset allocation of the portfolio. The assets that are expected to achieve higher return that are focused on return versus those that are focused more on downside protection and capital preservation. So the actual asset allocation versus the target here as of 9/30 shows a slightly higher allocation to return seeking than the target. Now keep in mind, in terms of what I just said, the overall risk posture slightly ticked up with the new asset allocation that was adopted in July. So now, reflecting that new target, the return-seeking component target will be 76%, and the capital preservation will be 24%. So this actual allocation as of 9/30, it's very close to what the new target is. This is reflecting the older target, and then as the assets moved, we're updating the target allocation in our reporting as of 10/1, and that'll be reflected in the next quarterly report we present. So if you look at this and say the risk posture is off of the target, it's actually not off of the new target. So I did want to note that. That's important in terms of understanding the overall risk position of the portfolio. If we move on from here, I'm going to cover, keep moving please. I'm going to cover, keep going. Thank you. I'm going to cover this slide and the next slide. Jim already covered the performance in the context of the benchmark and the peers over the long term. That performance profile does look strong, as Jim said. Generally, the performance has been above median, particularly in recent periods. So that's good to see, as well as over the very long term too. I'm going to cover the recent performance here to give an update there and then see if there's any questions. So this is showing the last quarter. As I said, for markets in general, this is a muted return period for public markets. The public market equivalent benchmark, as I said earlier, was actually negative 0.63%. So very muted returns in public markets. The SIRS portfolio did outperform the target and also had a positive return overall, so 2.53% versus 2.02. What drove that positive return and the return above the benchmark? It was the performance in the private market, so private equity returns were very strong, as well as real estate had strong absolute performance, as well as being above the target. So keep in mind here that the returns for private equity, for private credit, and for real estate, these are quarter lagged returns. So you are seeing a positive impact from that quarter lag when you think about what happened with markets in Q3 versus Q2. So overall, this was a good quarter for the portfolio. If we go to the next slide, it shows it over the 1 year attribution. So 1 year is stronger. That again reflects the recovery coming out of the pandemic that I mentioned earlier. So 25.21% return for the portfolio versus 22.37% for the target. And so this is a strong absolute return. If you think about the 7% actuarial target, this is well above that. And then also positive performance driven by positive manager performance as opposed to asset allocation being different than the target over the year. You can see the manager effect. So the impact of active management, that really drove it, 2.63% versus the asset allocation having a much smaller contribution. And the impact in terms of relative attribution, it was broad-based, so multiple areas delivering outperformance relative to their targets. Also, the overweight to private equity over this period did contribute, and having a slight underweight to real estate also had a positive impact on relative return. But overall, this was a really strong period for the portfolio in terms of returns on an absolute basis and also relative to the target. So I'll stop here and see if there's any questions, and then we're also going to cover the 401A and the 457B plans. So any question? I do see a question. Is that Alan?
Yes, it is. Hey, how are you, Tom?
Hi, Alan.
Good. Thanks for. Can you hear me?
Yes.
So two questions that are related, but would, very interested in your feedback on both. With the unfolding China situation, you mentioned Evergrande, but they're really kind of the pinnacle of a much broader problem. There in China, and there's any number of real estate development firms and construction companies that maybe not to the extent of Evergrande, but are also extremely highly leveraged. 4 or 5, as much as 10 times what you would see from a similar firm in the United States in the same industry. And, kind of wondering whether you see that situation having, broad systemic implications, potentially in terms of China having a protracted period of slow to perhaps even a recessionary period for, multiple years, and kind of how that would shape the global outlook for markets and what that impact would be to us. And then have a follow-up question as well. Thanks.
Yeah, it's hard to say at this point, Alan. I do think that it could have broad-based impacts, certainly domestically, because as we showed on that slide, real estate-related activity is a very large part of their economy. So it also depends on what kind of government intervention we see, where there's the idea of, is there an attempt to combat moral hazard where they let companies fail and try and punish some of these excesses versus how much intervention there is. The counter would be, we're going to relax things like lending, free up more capital to try and save more of these companies, because there is a lot of real world impact. It's not just about markets. So you may already know this, but for instance, there's promised residences to Chinese citizens that they haven't built, and folks have prepaid for in certain cases. So there's also the impact potentially of social unrest, where if there isn't intervention to deliver, then they could also face social unrest from some of their citizens. So it is definitely a very complicated situation, and we'll have to see what the longer term impacts are. There's other parts of this transition too that we haven't even gotten into, I think also has broad-based implications for China, like trying to move to more sustainable energy sources. But then what's the impact to citizens in terms of not having access to heat? So there's a lot that's going on there in terms of trying to transition the economy to more consumption-based, but then dealing with all of these different excesses and pressures while maintaining social calm, I'll call it. So I couldn't say in terms of the longer term what the longer term impacts will be. The other point I do want to make, though, that I think is important to understand is there is definitely potential broader economic impacts than what's going on there domestically. But in terms of their slice of the markets, in terms of stocks that are actually Chinese stocks, it's really a pretty small portion of global markets at less than 4%. Of course, many companies derive a lot of their revenue from China, and that's really more where the issue is. It's not the domestic Chinese stocks, it's the fact that so many global companies derive meaningful shares of revenue from the Chinese, from China domestically. Hopefully that helps.
Yeah, that's helpful. And then my second question is related to the TIPS portfolio. I think it was about 3 years ago, we had contemplated, potentially liquidating that portfolio. At that point in time, we're sitting in an environment where we hadn't had inflation in a long time. There didn't seem to be any reason for inflation on the immediate horizon. We were kind of considering moving that from TIPS to, I think, nominal bonds at one point in time. And, now we're in a very different dynamic than we were 3 years ago with inflation and the potential timeline for that. I'm kind of wondering, whether, and we have no opinion on this, whatsoever. So really just looking genuinely for your thoughts on this in terms of, whether that's a decision that maybe should be revisited in light of kind of the change in the inflation dynamic, and what do we think about that portfolio allocation long term? Is that part of the asset allocation long term, or is that something that we wanted to hold on for a period of time, potentially until inflation kicked up like it has?
Right. It's definitely one that tested everyone's patience over the period up until COVID, where we've had such muted inflation in the US and globally, and there was a lot of debate about the utility of dedicated inflation hedging in portfolios. The advantage of TIPS relative to some other inflation hedging strategies is it is relatively low volatility, and that was part of the appeal of keeping it, was relative to, let's say, commodities, which are extremely volatile and have had very long periods of negative performance that have been very difficult for asset owners to endure. TIPS, less volatile, one form of inflation protection. There's others like real estate. We could talk about how equities reflect inflation over longer terms. So there's multiple ways that inflation hedging can exist in a portfolio, but TIPS is certainly one of them. If you remember, it actually went down a little bit in the most recent asset allocation because of the desire to increase the return risk profile relative to the target. So TIPS actually went down a little bit from 4 to 3%. And Jim Nolan may want to weigh in here, but going into next year, we're looking at the whole asset allocation, and part of that will definitely be inflation hedging, including the TIPS component. So that's all on the table from a Callan perspective, and I believe from a SIR staff perspective as well. Jim, do you want to add to that?
Yeah, that's correct, Tom. Thanks for that. And I also want to refresh everyone's memory back when that concept was being considered for the entire liquidation in the TIPS portfolio. Chair Becker questioned that and had that postponed to another meeting to get more insight and more research done on it. And Tom, I remember you specifically cautioning us that nobody warns you when inflation's coming. It's too late when it comes, and you can look at the returns up on that screen. You'll see how additive TIPS have been relative to fixed income, several hundred basis points. So in the actual return column, it's been an incredible win. So we want to, I thank Chair Becker for questioning it, and Tom, your team for keeping us on the tracks for the unknown future. So we'll continue to look at the asset allocation, as you said, and we'll be coming back in February with some ideas.
Yeah, that was really well done a few years ago by you and team. Jim, I think you're in the acting room at that point. And,
right.
Callan was involved in that decision, and obviously Chair Becker. That was a very good decision at that point in time. So I wanted to applaud you for that as well. That's the end. Thanks.
Thank you. Okay, Tom. Unless there's other questions.
Okay, I'm going to turn it over to Bud, who's going to go through the 457B. Thank you.
Good morning, everyone. Bud Fleck from Callan. Whoever's controlling the presentation, if you can go to the deferred comp 457 plan, and let's skip ahead to page 9, and I'll go pretty quickly. We're falling behind schedule here. Page 9. Thank you. So this is a snapshot of the asset allocation as of the end of the quarter, September 30th on the left, and then new contributions for the quarter where they came in for on the right-hand side. As you know, this is a participant-directed plan. So new contributions are a little bit less in U.S. large cap than historically the asset allocation has been, a little bit more in SMID cap, certainly more in stable value, and less in the retirement date funds. So that's just how new contributions have been coming in as of the latest quarter. Just flipping to page 10, looking at the assets in dollars, the total plan is at $4.6 billion. with almost $1 billion or 19% in the retirement date funds, $1.8 billion or close to 40% in U.S. equity, and $1.5 billion or almost 33% in fixed income. If you flip to page 12, one of the biggest drivers of performance in the target date funds is how they are positioned from an equity roll down exposure over time. So at this bottom chart on this page, you can see that the BlackRock LifePath Retirement target date funds have a higher exposure to equities compared to the peer group on the longer dated retirement funds. So 40 and 30 and 20 years from retirement, there is more equity in the BlackRock funds. And that helps explain performance. When there's a strong equity market, BlackRock is going to tend to outperform. BlackRock is also managed passively using index funds. So in times where index is outperforming active management, that also is an explainer of relative performance. But on the roll down, you can also see that as you get closer to your retirement date, the BlackRock funds have less exposure to equity versus the peer group. And so you'll see that in some of the vintage years of the target date funds, performance is below median for some of those periods and some of those funds in recent periods. So let's take a look at performance on page 17. The stoplight pages, I think, are the easiest way to take a look at performance. And so anything that is in green reflects that the performance is above median. Anything in yellow means that it's in the third quartile, and red meaning that it's in the fourth quartile. So for the most part on this page, the target date funds are in green. Because they are passively managed, they are doing a good job of mimicking the performance of a blended index. So in that case, all the funds are tracking the indices very closely, but there are time periods, especially with the 2025, 2030, and 2035 funds, where they have fallen below median over the 5 and the 7 and 10 year time periods. And again, that's reflective of the roll down exposure to equities. On the next page, page 18, has the single strategy funds. The domestic equity is a fund that's looking to mimic the performance of the S&P 500, and it's done a very good job of doing that. And it's very difficult for active managers to outperform the S&P 500, so most of the time periods, or all of them shown here, are in green. Similar for SMID cap. The non-U.S. equity space, where active managers tend to have a higher probability of outperforming, you see that the index fund is below median over a number of these periods. The short-term investment fund is in the fourth quartile, but as we've mentioned before, our peer group includes a lot of other more aggressive type short-term investment funds that have securities that are outside of the scope of your short-term investment fund. Your stable value fund, which has a significant amount of participant assets, is doing extremely well. And if you look on the next page, page 19, you see how that fund ranks against other stable value funds in the peer group. With that, I will end my comments and see if there's any questions on the 457 before turning over Britt to Britt for the 401A. Take it away, Britt.
Thank you, Bud. If we could pull up the 401A executive summary, I will begin my comments on page 9 and try to keep this relatively brief. On page 9, we show the asset allocation and the contributions as of September 30th. As you can see, the retirement date funds make up 82% of the current assets, and as this is the default allocation, if participants do not make a choice in this young plan, it continues to make up a large amount of the total assets as well as the contributions, which you can see on the right. If we turn ahead to page 10, showing the assets in dollar terms, total assets in the 401A plan are up to $62.6 million. Oh, I'm sorry, if we could move ahead to page 10, please. One more.
It should be on, it's on 10, Britt, the market value.
Okay, my screen must be frozen. But as you can see, 62.6 million, and again, most of that in the target date funds at about 53.8 million. And you can see about 8.5 million came in during the quarter from participants, and some negative investment returns due to the muted equity markets. On page 11, just highlighting some of the changes in the market values. Given that the target date funds are the default, in the top right, you can see that they grew the most during the quarter. And on the bottom chart on page 11, you can see how contributions from participants have ebbed and flowed over the years since the inception of the plan. I will not highlight the target date fund performance as Bud just went through the glide path. If we turn ahead to page 15, we show some of the individual index option performance, and all of the individual options tracked their benchmarks adequately. And over the last year, you can see very strong absolute performance from your domestic equity options as well as international equity options. Lastly, on pages 17 and 18, I would just like to highlight the fees for each of the investment options. The expense ratios are located on the far right side of 17. You can see at 8 basis points, the target date funds rank in the cheapest quartile of peers. And on page 18, we show the individual options, and you can see again, very competitive fees really across the board. With that, I will pause. I'm happy to answer any questions. And if not, I'll turn it back to you, Jim.
Okay. Thanks, Britt. Bud, Tom, appreciate that. Trying to stay on schedule here. We're going to advance to 5C and board docs now. There was some discussion after the pacing update that StepStone and NEPC had done for the private equity, private credit, and real estate, respectively. And the team has worked with the consultants, and they have a brief update that we're going to cover here. Tomorrow we'll hear a more in-depth, deeper dive into understanding the mechanics of private markets, again by Mike Elo from StepStone. But Bill Chong's going to take us through the highlights of what these two consultants, both Mike Elio and Matt Roach, maybe there from StepStone, who you all know, and Matt Ritter from NEPC. So, Bill, if you would take it, give me the overview, please, and then bring them on.
All right, thank you very much. Good morning, members of the committee. As you recall, our prior meeting in September, the board's private equity consultant, StepStone, and the real estate consultant, NEPC, presented an update to our pacing analysis. Our overall goal is to ensure that this committee has all the information that it needs, to help them make, to help you make the decisions. And which is why we're back here today with StepStone and NEPC and the investment team. We'd like to present an update to the private markets annual pacing analysis. And you may ask why. Well, there's two main reasons why we're back here today. The two main reasons are, number one, the private equity assets in our program has significantly increased in value. I think it increased by approximately 14% since the last analysis was performed based on the values within a quarter. So within the quarter time frame between March and June, the private equity program increased in value by 14%. And what that means is the private equity assets increased by, over $500 million, which is why we felt it was necessary to come back to perform an update or to present this committee with an update. Our plan for the future is to come back annually to this committee with a updated pacing analysis every year. The second main reason why we're back presenting to this committee is there was a question at the last committee meeting in regards to stress testing the private markets assets in different market environments. So, the investment team worked with Stepstone and NEPC to conduct several scenario analysis, and these scenarios are very similar to the scenarios that Korn Ferry, our actuary, performs on our total plan. We took 3 scenarios from the Korn Ferry analysis. The first scenario is a shock scenario. What happens in 2022 when there's what's the impact to the private markets program if there is a 20% decline in the fund in 2022? The second scenario is a downside scenario on determining what is the impact to the private markets program if the fund returns 5% a year over the next 10 years instead of the 7% actuarial assumed rate of return. The third scenario is an upside scenario. What happens if the fund returns 9% over the next 10 years? What's the impact to the private markets program? So based on our conservative and disciplined approach to moderately increasing or decreasing our annual pacing commitments, from 575, which was an analysis that was performed in the fall of 2019, to 800 million a year for the private equity program, which is our annual pacing that we presented at the last meeting. We still believe at this time that it's a reasonable commitment level for 2022. Mike Elio is here to present a brief presentation on private equity and private credit. Matt Ritter is here to present a basic preliminary, a summary update on the real estate program, mainly for the shock, the scenario testing analysis that we performed. If there aren't any questions, please, Mike, proceed.
Sure. Thanks, Bill. And Katie, I'll try and be efficient and go through this pretty quickly to make sure we stay on time. This is a presentation that we just presented recently. We updated it, as Bill mentioned, and we'll be doing it annually as we go along. So quickly on slide 4, just waiting for that to come up. There we go. So that's just a reminder of we need to keep consistent pacing to maintain vintage year exposure in your portfolio. You have historically ramped up and ramped down that commitment pace, and we've seen the impact it's had on the portfolio. So what we're recommending, if we shoot ahead to slide 6, is really, believe it or not, the same thing that we recommended before. As Bill mentioned, you were up significantly in Q2 in your private equity portfolio. The numbers for private equity on an annual basis are spectacular, up 77%. But the other side of the story that you may also have noticed is your distributions are also incredibly strong. This past quarter for Q3 alone, you had almost 500 million in distributions coming off the private equity portfolio. That is a record for PA SERS. And it's been consistent over the last few quarters how much capital is coming off the portfolio. So more is coming out than going in. So if you look at the pacing, we're still looking at an $800 million a year pacing to maintain that vintage year exposure. If you go to the next slide, this is the private equity sensitivity, the Korn Ferry stress test model that Bill mentioned. You can see that we repegged it based as of 6/30 with the numbers that you're familiar with in the other reporting that you see on the portfolio. And those are the three scenarios. The yellow scenario, of course, you can see is the Korn Ferry, the world drops 20% at the total plan level. And you can see that PE shoots up, but then, of course, goes back and reverts to the mean because you're still contributing less than the overall growth of the portfolio, and you will still get to your 12% target return over time. The green line, as Bill mentioned, is a 5% investment return. So it says that you actually decline a little bit slower because the overall assets are not growing as quickly. The blue line is based on your actuarial returns, and that's really assuming everything goes according to textbook. That's the glide path that you will have, getting back to the allocation that you're targeting. And then, of course, should things not go quite as well, and you're at a 5%, actually they do better at the overall plan return. Private equity, of course, will drop even faster as a percentage of the overall plan, and you would end up at almost half of your target return, target allocation in PE. Obviously, we wouldn't sit around for 10 years waiting for that number to drop that low. We'll rerun this every year, but this is to give you some of the parameters of what your exposure would look like given certain scenarios that would happen in private markets or in public markets overall, and the impact it would have on private markets. If you, I'll skip over some of the slides that are very similar, slides 8, 9, 10, and 11. If you go to slide 12, the private credit portfolio is below target, so it's a little bit different scenario. So if you do a stress test scenario there with the overall plan dropping 20% and then returning to normal pace, you actually get closer to your target faster. So that makes just common sense. And you can see similar scenarios based on the 5% investment return, the blue line being your actuarial, and of course the gray line being the overall plan outperforming its actuarial targets. Interestingly enough, you almost never get there if you outperform your actuarial rate. So we would have to, again, reconsider our commitment pacing given those scenarios. So overall, performance and pacing within these two portfolios are modest. We are not pushing the limits of what we should be committing to this space. Either way, we're committing enough to maintain proper exposure, but take it down in a methodical way to get to your target. In the same way that we suggest, for instance, on private credit, you methodically get there over time. You do the same thing on the way back. It's just common sense portfolio construction for assets like these. We will continue to run this. As we mentioned, the distributions coming off this portfolio are incredibly strong. Given the numbers, these were actually run at, I believe, 38 billion. You guys are up over 39 billion already. So it just means these numbers are constantly changing. So we will revisit this again on an annual basis and present it to the board. So I went through that really quickly. I wanted to make sure Matt Ritter had time as well. So if no questions, I'll pass it on to Matt.
Awesome. Thanks, Mike. So I think this will be the next item in the agenda, 5C. So not next item, next attachment. So a lot of this is going to be a repeat of what Bill and Mike have said. So I'll again try to keep it pretty brief. But if you want to just turn to slide 2, I guess the one difference here. So we did update from March 31st to June 30th, but there was not as dramatic a change for the real estate portfolio as there was for private equity. So really the focus here is just looking at the outputs of that sensitivity analysis and seeing how the portfolio looks under those various scenarios. The one thing I really want to emphasize on this slide is something that both Bill and Mike have said, but I do think it's important enough to highlight again, which is that the plan all along has been to revisit these pacing plans on an annual basis. There's a lot of high-level assumptions that go into these plans. The biggest one we're talking about today, which is that total net plan growth rate. The assumption over a long-term average is that will be about 2%. But of course, in any particular year, it's never going to be exactly 2%. So it's important to keep that in mind that, when the pacing plan does show a 10-year forecast, we're not still going to be following the same plan in Europe. It will be updated and reconfigured as things change. So with that, I guess quickly we can go to slide 3. Again, a lot of this is a repeat as far as, what exactly we did here. But again, just wanted to highlight one main thing, which is the only change we've made in the sensitivity analysis is to that total planned net growth, meaning that the future projected commitments and all the other assumptions are the same as what you saw at the September Investment Committee meeting. Of course, as Mike said and as Bill have said, if one of these scenarios will play out, we would update the plan and change those future commitment amounts to, get the plan back on track. So moving ahead one more slide, slide 4 lists the individual scenarios. And these are the same scenarios that Mike just went through. You've got the base case, which has the 2% total plan net growth rate. There's the downside and upside scenarios. We change the return assumptions, the investment return assumptions for the plan by 200 basis points in either direction. And then the shock scenario, which has the negative 20% investment return next year, followed by a reversion. So with all that background out of the way, we'll get to the actual outputs on slide 5. The shape of the curves that you'll see here looks very similar, unsurprisingly, to what Stepstone showed for private equity. As a reminder, the target allocation for real estate currently is 7%. And that dark blue line, which is the base case and what was presented in September, tracks pretty closely to that 7% target. Unsurprisingly, the scenario where the plan grows faster than expected, the real estate allocation essentially lags because it's not growing as quickly. And, over a 10-year time frame, it falls to about 5.5%, so under target. And then similarly on the other side of things, where the plan grows more slowly, and also obviously the case where there's a market shock, you see that the portfolio becomes over-allocated relative to that 7% target. But again, of course, this would be accounted for in future pacing plans where we would adjust the future commitments to make sure we're staying on track. So really, that's all we have prepared as far as the sensitivity analysis. Again, we'll see if there's any questions or Bill, if there's any last comments.
All right. Well, thank you very much. Back to you.
Yep. Thanks for keeping that brief on a very complicated subject, but the materials are there on board docs. Any questions, we certainly can get back to folks or set up any meetings that you want to get more explanation. So thank you for that. Okay, with that, trying to keep moving here. If we move to item 5D, as in David, that's one of the first of 4 private market opportunities that Glenn mentioned at the beginning of the meeting. This one here, PSG. Europe. We'll start with the CIO introduction slides, please, Kelly. And as you can see up on the screen, we can advance to the next page. Just a little table of contents, and we'll go right through that. If we can move to the next page, we'll see a 10-year pacing chart. This is also in the presentation that you just heard from the private market consultants. The important thing we want to point out here, first of all, how to read this chart. The blue line in the center, as you can see down in the legend, is associated with putting out $800 million to the private equity program. And as Mike just covered, even if we did that with all our assumptions, I think Mike called it the textbook outcome, where all the assumptions on inflation, expected returns, benefit payments, everything included, we'll end up out 10 years a little bit below the target. We have that line drawn. That That's where we're trying to get to 12%. But as Mike said, we're not going to hit the panic button and start putting out $1 billion a year, which would be that green line up there. Instead, we're going to just take a step in the right direction, get it up to $800 million, and then revisit it on an annual basis. So just want to keep our eye on that. As opposed to what we see on our current asset allocation reports, the private equity is higher than our target right now, which is a first-class problem. It's because the asset class, as Mike mentioned, is up in excess of, I think he said 70%, but I have to look at the report to see the specific number, and that's a good problem to have. It has grown so rapidly. The next chart, please, Katie. Mike also mentioned the distributions, how they're coming in. The plan is not only, the private equity plan is not only self-funding itself, it is generating positive cash flow to the system this year with the incredible distributions which are represented in the solid dark bars above the zero line. The lighter blue colors below the zero line are contributions going out the door. So you can see that the plan, our private equity portfolio is generating significant cash flow. So the assets are rising, making them appear to have a higher percentage of the plan, but the distributions are also coming in very fast. And if this continues, you could see yourself with the total exposure of private equity falling below our 12% target. But again, that would be a good thing if distributions came in faster and faster. So we'll keep an eye on this each board meeting, each opportunity. You'll see these slides to keep this refreshed. With that, Katie, we can go to the next slide. The two columns in the center, there's a left and right column marked previous 2019 and updated pacing 2021. We hadn't done it. We're trying to do this every year now. As you can see, it got a little bit off tracks. We didn't do it for a little bit of time, and we had significant contributions from Penn State, PASHE, to the tune of $1.8 billion came in. Those assets have to be invested along our allocation, private equity included. We've also had some decent performance coming in, so that's why the assets ended up at $38 billion for this pacing analysis versus 2019, when it was closer to $29 billion. So as a result of that, whereas it was assumed $575 million was sufficient to keep us on pace, it's become apparent that we need to move up closer to that billion mark. But again, we're going to take it in steps and just go to 800 for the time being. The math below that 800 million in the updated pacing column are the allocation that we have already approved year to date for 461 million, and then the two opportunities that we have today would bring us to the total. We still would not hit the 800 million, but that's okay. We're going to be able to work this through. It doesn't have to be precise, but it should be generally in line with the vintage years to avoid what Mike showed in a chart in his presentation of severe declines or overages in exposures in any one vintage year. So with that said, if we could flip to the next page. This opportunity that you're going to be hearing from, Mike Elio is going to do a portfolio fit, and then we're going to have the folks from PST come on and cover the material, the team, their diversity initiatives, etc. But they've generated handsome returns, as you can see, north of 60% gross IRRs on all their realized strategies on their platform. So we're bringing a top-tier manager into the board today to try to accomplish that pacing gap that we're experiencing. And then I'd just like to flip to the next page and cover a very important aspect for this board. We put a lot of time into this, communicating to the private equity community that transparency is important. And as you can see, this particular manager has agreed to have transparency on each of the items that we targeted is critically important. So with that, I'll ask Mike Elio if he could cover the portfolio fit and how this opportunity fits into their system. And I want to thank Ryan Morse and Bill Trong for the background work plus the analysts that helped them to diligence this opportunity. So Mike, if you go ahead.
Sure. Thanks, Jim. So PSG Europe is, PSG in general is a relationship that you all should be familiar with. You've committed to 4 of their flagship funds and, of course, to their European Fund 1. This is on Fund 2, and they're here to go through the details. But from a portfolio fit perspective, look, the strategy of PSG has worked well here in the U.S. Europe is behind the U.S. In their curve of adopting some of these software solutions that PSG is taking advantage of, and they are leveraging that to continue the success that they've had to date. This also continues from a commitment perspective, building out your growth equity exposure within the portfolio so that you are not too overweight in the buyout space. It also does add to your European exposure, which is lower compared to many of your peers in the market. One other thing I will mention, Jim already mentioned, this is a very high conviction top pick manager of StepStone. They also do offer co-invest to the plan. And so PA CERS should be able to take advantage of some of these co-investment opportunities to lower the fee profile that they have with PSG and hopefully continue that performance. But with that, I just wanted to keep it high level because we do have the pleasure of having the GP here to grill with questions. So with that, Jim, I guess we'll pass it to the manager. I think Peter's here today.
Yeah, that'd be great. And PSG team, Peter, hello. Thank you for joining. If you could each introduce each other and then, try to stay on pace here, so keep high level, and then we'll open it up for questions.
Sure. No, thank you very much. I'm Peter Wild, and I'm one of the 2 founders and chairman of PSG, and I actually think this is my 4th or 5th time presenting to this board. So thank you all for your support. And I have with me let Lisa, Danny introduce themselves, and we'll jump right in.
Hi, good morning. Danny Ramal, Managing Director with PSG, and I lead the team here on the ground in Europe.
Hi, I'm Lisa Lee. I'm a Managing Director and based in New York, and have had the pleasure of working with the PACERS team for many years, and really appreciate all your support and partnership.
Great. So I'm going to be conscious of the fact that we have presented to you all before, so we'll go high level, and we know if you have questions, you'll jump right in and redirect us. But if you do, if you could advance the slides 1 here. Basically, what we do at PSG is we've built an infrastructure to do small software at scale. So we have a large operations team, we have a large sourcing team, we have a large investment in the technology for our sourcing, and we have one of the largest software teams of any size in private equity, but it's really focused on being at that founder bootstrapped smaller level. Because, as you see from the returns, what we see is with the enormous amount of money in private equity that's searching for software, being a manufacturer or a minor league system where we can sell up into that investor base has been a great strategy. And, it's been evident in the returns. I can tell you right now we have a lot of activity going on between now and year end, so I think you'll continue. Just in hearing some of these earlier comments on distributions, you're going to continue to see that from us because we are aggressively working to realize gains in this market. If you look at the next slide here, this is just to give you a quick visual on where we're trying to be below all these folks, start really small. One of the advantages there is a little bit over half of the capital that we deploy goes in as follow-on investment when we've already made the initial investment in a company. So it's been de-risked. We've already started our work on building a management team. We're heavily into what our M&A strategy will be, and our ability to re-underwrite those opportunities and generate higher return with that follow-on is high and has proven over time. And what we're then trying to do is build that scale, sell it up the food chain, as you see on this chart. So a typical deal for us would be the next page, if you could advance to 3. And we're looking at, 25 to 50 as an initial check, just to give you a sense. PSG 1, which was around a 300 million fund. The companies in the beginning of PSG 5 in the US, which is a $4.7 billion fund, on average are about 20% smaller. And that's because that's where we see value in the space. So all the infrastructure we have, we are not doing what kind of a typical movie you've seen before would be, is GP generates good returns with one strategy, raises more money, strategy drift, starts to move into a more competitive market. We are fully committed to the small end of this market because that's where the value is, both in the US and, as you're going to hear from Danny, in Europe. And then what you see on page 4 is the infrastructure that we have, which is a real advantage. I mean, we have 16 people on a sourcing team, 34 people on an operations team. Those two groups are our fastest growing areas, so we will continue to be adding to both of those teams, particularly in Europe over the course of 22 and 23. But this is a lot of infrastructure to bring to bear to invest in a founder's business that may have 10, 15 million of revenue. They typically would not have reach outs from private equity firms that would have this type of resources to bring to bear to help with their success. And then just on page 5, give you a sense, we have over 150 people in total in the team. Gender diversity is 28%, minorities 20%. We are making great progress here. This has been a big initiative. You can see where we were in 2017. We've had to really put a lot of effort behind this. And while we're proud of the progress we've made, we acknowledge we are far from done here. And we'll talk a little bit about our ESG initiatives a little further on here. So with that, I'm going to pass it to Danny in the next slide, 6.
Thank you, Peter. In Europe, we're also very focused on diversity, and it's very important actually for our success here to operate on the ground across continental Europe specifically. So we have built within PSG 37 team members based in London and in Europe to pursue the PSG playbook of investing in small-scale software companies and grow them through buy and build all over Europe. One key differentiator we have, other than size of the team, which positions us as one of the largest software and technology investors on the continent, is that this is a very diverse team that we have put together. We have about 15 languages spoken. All of the core European countries are covered by our team. We have a lot of Germans, French, Spaniards, Italians, Northern Europeans, which is very relevant to actually operate successfully in Europe and deploy our strategy. Next slide, I believe, is on our ESG progress.
Yes. So on ESG, we have significant internal resources, but we've also brought in external resources because our view is it's always productive to have a third-party expert look at what you're doing and help us craft where can we do better. Because that's one of the things I think just in every aspect of our business that we've always looked at is we can always do things better, whether it's our ESG initiatives or our sourcing of the next deal or how we support a company. So we brought in Brewdog, and they've been doing great. I mean, your investment team has our inaugural ESG report. We're actually very proud of this. This is something we put a huge amount of time and effort into, and it's something that we will be making available annually, and we will obviously be updating every year. My partner, Mark Hastings, our CEO, is the lead on it, so there's real ownership from the top of the organization down, and everything we're doing is with the goal of being best practices for not only for private equity, but for the software industry, because we want to be able to help our companies with all of these initiatives as well. And that's one of the things on Plan Next Steps. We're working hard on particularly hiring. There's certain there's no company we have that doesn't have huge hiring needs right now with how software is just exploding. And so what we're working on is looking at non-traditional candidates in non-traditional roles for us to be able to train and bring into our portfolio. So again, it's something that we feel like we've made a lot of progress, but again, it's not something we'll ever be done with. We're always going to have to get better at it. With that, I will...
Next slide, just to put our strategy in perspective. PSG operates in the very large global technology funding market. This is about $150 billion worth of technology funding in Q2 2021 alone. It's a very large market. It's accelerating, and a lot of the acceleration has taken place during the course of the pandemic, which has led to a faster adoption of automation solution and business process digitization across all sectors of the economies. This is happening in the US, it's happening in Europe. Although Europe is far behind, this is a comment that Mike Elio made earlier, Europe is behind on the adoption curve compared to the US. As you can see on this slide, 30 billion of that 150 billion total quarterly funding market is in Europe. So Europe is today only 40% of the size of the US technology funding. A year ago, it was 26%. So it's growing fast and catching up on that adoption curve. Next slide, to illustrate further that Europe is behind but catching up. It's definitely the fastest growing region in the world when it comes to technology funding. Year to date, in the first half of 2021, we've seen 50 billion worth of technology funding go into European companies. That is more than 28% than all of 2020, which was a record year, as you can see from the chart on the left. And still 70% of this funding is still going to early stage companies in Europe. And only 30% of that is going to mid and late stage companies, which is what PSG focuses on. In the US, which is more mature market, already the mix is 50% to late stage companies and 50% to early stage. This means that Europe is a large market, it's growing fast, but the bulk of the growth is still ahead of us in Europe, and the acceleration, we think, is still ahead of us for technology funding in Europe and software funding in particular, which is relevant for PSG. Next slide. To put that in macro perspective, there is a big technology funding gap per capita in Europe compared to the US and Israel, which are much more advanced markets technologically. And specifically France and Germany, the two largest economies in Europe, as you can see from this chart, are still far behind at 150 to 200 funding going per capita to technology companies compared to over $800 million for the US market. We think this is an anomaly. It's being corrected, and you can see these adoption curve picking up. And part of the thesis for PSG is to exactly invest in these large economies, France and Germany, the Nordics, Netherlands, Finland, the UK, which are really catching up fast and where we see great opportunity going forward. Next slide is an illustration of what we see in Europe. As Peter mentioned, we're looking to back small software at scale. Europe is full of these companies. There are thousands of point solution providers that will provide a single software service in a single country with a small TAM compared to some of the large software companies in the USA. What we offer with the PSG sourcing and operations integration playbook is accelerating the scale-up of these companies through cross-border M&A to create pan-European leaders in each software vertical. And through that, we create bigger, more diversified companies with a bigger addressable market, and hence they tend to be more valuable. And that's our strategy, which is very consistent with our strategy in the USA since PSG Fund 1. Next slide, some snapshot on our portfolio. This is a very diverse European portfolio. The latest statistics is we've invested through PSG Europe 1, where you are one of the investors, In 14 platforms, we've executed on over 30 add-ons across 14 countries. As you can see from these slides, from this slide, we have many dots, many cities, tier 2, tier 3 cities all over continental Europe. We are heavily invested in France, Germany, the UK, Spain, the Nordics, the Benelux, and we will continue in Fund 2 to focus on exactly the same strategy with the same geographic focus. And the team that we have put together reflects exactly that geographic diversity. It mirrors the geographic diversity of our portfolio. And that's highly relevant to operate in Europe.
I might just make one additional point on this page. Every platform we have in Europe has a sibling in our US portfolio. So there's an overlapping investment thesis where we have shared learnings that are helping us execute hopefully faster, better, and more aggressively on our investment goals. And that's actually not something that we set out with a stated goal of doing, but that's how it's kind of evolved because we have such good integration between the teams that we're able to see trends that in particular have worked in the US where we can say that if this plays out as expected, this is a place we're going to want to be in 2 or 3 years in Europe. Let's go find a home for some capital.
Exactly. And on the next slide, we summarize a little bit the small nuance between the European and the US approach. As Peter mentioned, we follow exactly the same themes and we deploy them in Europe. And having seen these themes play out in the US gives us a big differentiator. The nuance we have in Europe is that we have many countries. We create scale and differentiation not only by making add-on acquisitions that will diversify the product suite and create multiple products that can be bundled and sold to the same end markets, but also creating businesses that operate across geographies and can provide services to their customers on a pan-European basis. And that's highly relevant given that Europe is integrating, at least economically, it's highly integrated from an economic and regulatory standpoint. And so having software providers at scale that can operate across multiple geographies is now critical in many sectors, almost in every sector of the economy. And PSG is a catalyst for that through the playbook of consolidation and M&A.
So maybe just to wrap up here, again, we're focused on the lower mid-market with a highly resourced team around buy and build. So acquisition, M&A is a big part of our strategy here to build these businesses up. And that's part of the reason why we need large operations and a large sourcing team. The shared infrastructure between the two geographies is not just IP, but there's a lot of our human capital that we're really benefiting from. That's working extremely well. We feel really good about where Europe is in its evolution here. I think there's a lot of capital that's going to be chasing larger software deals, and we're going to have a really well-placed portfolio as we create those. Prove over time to have good fit with founders and entrepreneurs. We try to have a very humble, let the company be the stars and those when we're interacting with companies. We are partners. We want to charge for our operational team. It's all about, like a lot of our peers, it's all about being a great partner. And again, we're very focused and committed to ESG, social justice. And I'd also say for your, the disclosure slide was an interesting one to me, because just to give you a sense, that was never even a discussion for us internally. I mean, our goal is for our LPs, any information you want, you're an investor, you're a customer, you're going to get it. So with that, we're open to any questions.
Any questions for the PSG team? Okay, apparently a job well done. No questions left unanswered. Mr. Becker, do you want to?
We move to the motion. Thank you, PSG team, for a very interesting presentation. We'll move to a motion. The motion is in order to recommend that the State Employees Retirement Board commit up to 70 million euros, not to exceed 75 million US dollars to PSG Europe to LP plus investment expenses and pro rata share of partnership operating expenses consistent with
Lost sound.
Lost audio there.
We lost
Yeah.
Just a reminder to leave your microphones, please, on mute. We're having some feedback here, so go ahead, Mr. Becker.
Is your microphone on?
No, mine was not on. Okay. Do I need to read it again? Okay. So, my apologies. Allow me to read the motion again. A motion is in order to recommend that the State Employees Retirement Board commit up to 70 million euros, not to exceed 75 million US dollars to PSG Europe 2 LP plus investment expenses and pro rata share of partnership operating expenses consistent with executed partnership documents as a follow-on investment within the private equity asset class, subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals within 12 months. May I have a motion, please?
So moved.
Thank you. May I have a second, please?
Second.
Thank you. We have a motion and a second. Any further discussion before going to vote? If not, Bill, may we have a roll call vote, please?
Yes. Chairman Becker.
Aye.
Senator DeSanto.
Aye.
Mr. Philman.
Aye.
Mr. Acco.
PSG, thank you for the great returns. Aye.
Treasurer Garrity.
Aye.
Ms. Marchowski.
Aye.
Mr. Jordan.
Aye.
Representative Schemmel.
Susan Boyle for Representative Schemmel, aye.
Ms. Soderberg.
Aye.
Mr. Flanagan.
Aye.
And Secretary Thal is absent. He's had to go to a meeting.
Okay, I have that 10 with 10 ayes and 1 absent. Okay, good. Thank you, and the motion carries. Well done.
Very good. Thank you, Bill, for reading those. Okay, and we are running a little bit behind schedule, so I'm going to try to move this along a little bit better. We're going to move to board docs. Item 5E is in Edward. And again, Kelly, if we could pull up the CI introduction slides. The good news is you're going to hear less from me during this one because we have the same slides in there for private equity. If you could just advance, Katie, please. Next slide, please. Again, this is the same pacing chart that we talked about, so I won't bore you through that again. And the next slide, again, is a repeat of the distributions coming in. And then the next slide shows our progress to date. And the next slide gets specific to this manager. As you can see, TSG has delivered very, very attractive returns here consistently across many funds with an average, you can see at the bottom of the page there, of 27% on a net basis. So we want to thank Ryan Morse for keeping in touch with TSG. This is a very oversubscribed manager, and we've been able to participate again with them here with this opportunity today. We're in one of their other funds. It took a few years until they had room for us, so we're happy to be talking to TSG. And the next page will show that important transparency. Again, all transparency categories are being granted here by this manager. And with that, I'll ask Mike Elio once again, or Matt Roach, whoever's on from Stepstone at the moment. Yeah, I see Mike. If you could just give a portfolio fit in the Stepstone view, and then we'll get over to the team at TSG. Thank you, Mike.
Thanks, Jim, and I'll keep it short given the timing constraints that we have today. As Jim mentioned, the story here is very similar to the story that we just talked about with PSG. This continues the theme of focusing our commitments on high conviction managers that have done well for you in the past, and this is no exception. TSG will continue your exposure in the consumer space, which is a good balance to your technology exposure that you have in the portfolio. It is a modest commitment in the space, so again, high conviction manager, exposure to the buyout sub-strategy, to North America and the consumer sector, which is a pretty small exposure that you have currently in the portfolio. It's under 17%. So with that, I might just pass it to the GP, who can go into further detail on their history, performance, perspective of the space.
Yeah, and Jamie, if you would have each of your team members introduce themselves and then take it away. Thank you.
Thank you, Jim and team. So I'm Jamie O'Hara. I'm president of TSG Consumer Partners. I've been with the firm for 24 years and actually was born and raised in the western suburbs of Philadelphia. Jessica?
Hi, my name is Jessica Duran. It's a privilege to be here today. I'm a managing director and chief financial officer at TSG, and I've been here since 2017, but have worked with TSG for 12 years, formerly a partner at Deloitte.
Next slide, please. You can continue to, thank you. So TSG Consumer has a distinct focus in branded consumer businesses in the middle market. Consumer, as Stepstone has highlighted, does well in good markets and bad markets. And we've been able to have our success basically driven by the fact that we're investing in companies that have immature product portfolios and have multiple opportunities to expand their distribution, either through additional channels of distribution or additional geographies. We're generally using lower leverage than other investors in the middle market, and we bring with us a deep toolkit of value add to accelerate the growth of our portfolio companies. And I'll talk about that in depth in a few slides. And importantly, we exit our portfolio companies generally to strategic buyers or to the public markets. So the returns that were shared in the prior slide were through June 30th and all funds. And we're focusing on our realized funds, which are through TSG 7B. So over the last 2 decades, we've generated a 29% net IRR and 2.5 times net MOI on just under $4 billion in aggregate invested capital. Next slide, please. So, before it was a focus within our industry, we began over 20 years ago to build the current team that we have today. And over 40% of our senior leadership are women. Women are making 80% of the purchase decisions in U.S. households, and many of our entrepreneur partners and managers are female. And we need to bring the perspective of both men and women to thinking about strategy and thinking about building relationships with our entrepreneurs. So it's just been core to us. Jessica, do you want to talk a little bit about this?
Sure. I mean, as you can see on the slide, the data points here show, as Jamie pointed out, the gender diversity and the racial diversity for TSG, and among the senior members of our organization and our investment team members. But we also are partnering with an organization to create TSG Internships. This program includes the development of a special projects curriculum and is focused on providing underserved, first-generation, diverse college students with exposure to the investment management industry. And it provides opportunities for training and mentorship. And one of the goals for this program is to contribute to cultivating a diverse pipeline of talent. We'll go to the next slide.
ESG is also something that's been critical for TSG since our inception. So we've always invested in branded businesses, and we've recognized since our inception the hard work it takes to build a trusted and authentic brand, and how quickly that brand can be tarnished through bad behavior effectively. So it's been in our DNA since inception, but we've been fortunate to partner with some special companies and really push those companies on their ESG practices. And one that I'll highlight, which is in TSG 7, is called Brewdog. They are a craft brewer based in Scotland. They have distribution in the U.S. They have a facility in Columbus, Ohio. And they, 2 years ago, announced that they were going to go carbon negative, so return twice as much back to the system as they use in their business. And they're going to accomplish that through building a forest in the Scottish Highlands. So they've acquired the land, they're finalizing their permitting, and they're going to plant millions of trees over time, and really have this core tenet of ESG as part of their brand. We have several other businesses that have similar levels of focus on ESG. Duckhorn, which we took public, the wine company, about 9 months ago, just released their public ESG and sustainability report. So this is really core to who we are. Next slide, please. So before we jump into much more capital at the table, I want to just give you a sense for the businesses that we invest in and the businesses that we won't invest in. So we really have three focus areas. One are product businesses that go through multiple channels of distribution. Brands like Vitamin Water and Smart Water, ELF and IT Cosmetics, Chemical Guys, which is a car appearance chemical business that sells through their own website, Amazon, big box retailers like Walmart and Advanced Auto and AutoZone, Pep Boys, as well as their own franchised detailed garage stores. So very multi-channel. We focus on e-commerce businesses. E-commerce businesses like Revolve Clothing, Canyon Bicycles, Power Stop Brake Kits, direct-to-the-consumer branded product businesses. And then finally, multi-unit businesses, businesses like Planet Fitness, where we invested in the franchisor back in TSG 6, and then the leading and original franchisee in TSG 7. And then Dutch Bros Coffee, which is a drive-through coffee chain based in the Northwest, which just went public in late September, and has gone from about 200 units to 400 or 500 units. So those are the types of businesses that we invest in. What we don't do is we're not going to invest in brick and mortar retail that's selling third-party product. Clearly, the DTC nature of consumer has made that a very tough business, combined with a pandemic. So, sources of alpha: digital strategy, M&A and geographic expansion, product innovation, channel strategy, and team building. So, Yeah, I'll pick on chemical guys quickly because we started just in Amazon and our own website for that car appearance chemical business, car waxes and car washes. And then we added brick and mortar retail in the Walmarts and the AutoZones, and then we added the detail garage business. We took that company from 15 million in EBITDA to 60, and we exited it in 3 years and 3 months for 4.1 times our money. Jumping back to digital strategy, Revolve Clothing. We were one of the first businesses to think about influencer marketing, not in terms of a handful of celebrities, but in terms of 1,000 or 2,000 different smaller influencers, and built that business, took it public, and made over 10.5 times our investment for our investors. Canyon Bicycles, a high-end bicycle business that was based in Germany that we brought to the U.S. We did one website globally in all different languages, and in about 4.5 years, we returned 6 times our money on Canyon. So we get very deep with our businesses. We think like operators and sales and marketing strategists, and we're great at recruiting. So Planet Fitness and It Cosmetics, I think Planet had maybe 50 people in the headquarters when we made our investment. It Cosmetics had 4. When we exited Planet Fitness, we had built that to over 250 people, and It Cosmetics to over 150 people. We returned 10 times our investment on Planet and 25 times our investment on It Cosmetics when we sold it to L'Oreal. Next slide, please. Jessica, do you want to touch on this?
Yeah, certainly. I mean, these, as Jamie alluded to, these are the criteria through which we provide the lens through which we examine each investment opportunity. In terms of focusing on enduring consumer trends in attractive companies with favorable deal dynamics and with the opportunity to generate alpha. You can see on the left side in the upper box, they generally $100 to $500 million of fund capital per investment, as we seek to ensure a certain number of investments per fund. Generally, annual revenues between $100 and $1 billion, and as Jamie also alluded to earlier, a prudent use of leverage in facilitating growth investments. In terms of our portfolio, we have a mix of both majority and minority positions, and seek to have board representation, and also, often structure with the downside in mind in certain cases, to the extent we have a preferred security. And we partner closely with our companies, generally aligning with teams that will roll over meaningful management positions as we partner with them. With respect to target company characteristics, Jamie also spoke to this, but having a large addressable market with opportunities for significant organic growth, but also having the multiple levers for expansion, whether that's through M&A, product innovation, or channel or geographical footprint expansion. And of course, leveraging and amplifying this through our digital marketing team. And then, finally, obviously having strong teams. Jamie alluded to the building out of our teams with Planet Fitness and IT Cosmetics, ensuring low risk of technological obsolescence, and then always having a path towards exit as well.
I think it's important to just get a sense of how we operate in that whether or not we own 80% of a company or 40% of a company, we view ourselves as going to work for that management team and that founder base. So we think a lot more like consultants and sales and marketing strategists versus what other large kind of generalist funds that might have a consumer vertical. they might look at the same businesses that we're looking at, and they won't necessarily roll up their sleeves. They might have a senior executive who was a CEO in a similar space that company will report to. Whereas we're going to have 5 or 6 members of a deal team that are going to ask the right questions, are going to do the analysis, and are going to drive product innovation, channel expansion, M&A. We're a very hands-on group. Next slide. This is just a sense for what Jessica just took you through. About 50-50 in terms of control and minority, TSG 6 through TSG 8. Our leverage is generally lower than market would bear because we're investing in the activities that will grow the business. We've done about 20% of our deals in Europe and the Middle East. Those companies are facing the same direct-to-consumer digitization trends that the U.S. business faces, and our skills are very leverageable over there, and the success that we've had with those businesses demonstrate that. Next slide. I think we're close to wrapping up. And we are ready to wrap up. And I want to thank Pennsylvania for the partnership that we've had over the last 4 years, and happy to take any questions.
Treasurer?
Thanks. I just have a couple of questions. The first one would be, how do you plan on scaling your capacity to manage a fund that looks to be significantly larger than your previous fund?
So a great question. When we entered TSG 8, we had 9 managing directors, and we now have 16. When we entered TSG 8, we had close to 30 portfolio companies. When you think about the public businesses that we have, as us selling the stock and being in position to no longer control those businesses, we're going to have about 16 over the course of the next 18 months until we add new ones. And then I think most importantly, we're going to do about 10 transactions in TSG 8, and it's our intent really to do the same size investment and just do more like 15 of them. Co-invest is very important to many of our partners. I know it's important to Pennsylvania. So we're looking to continue on the same strategy and provide that opportunity.
Thank you. And then my second question is, how do you plan on mitigating the negative effect that the one particular concentrated holding could have on your performance?
So Core Power Yoga is the investment that has been hit by governmental mandates and consumer behavior through COVID, right? So we have written that down greater than 50% from our basis. Our membership rolls are coming back strongly, so we're almost to 50% of pre-pandemic membership rolls. We have the capital to continue to meet our current cash needs, and then hopefully by the end of next year be investing in new units. So we think we're going to get that business back to at least cost, if not better. But the portfolio overall only has a 1.2-year weighted average duration. So the story is really going to be written by the Rough Countries and the Mavises and the Superstar Car Washes of the world, which are our 3 2021 investments. And all 3 of those businesses are growing organically north of 20%. So we don't expect different returns in the future than we've had in the past.
Excellent. Thank you.
Okay, any other questions? Any questions? Treasurer?
If there are no further questions, Jamie and Jessica, thank you very much for a very interesting presentation. And we will move to the motion. The motion is in order to recommend that the State Employees Retirement Board commit up to $100 million to TSG 9 LP plus investment expenses and pro rata share of partnership operating expenses consistent with executed partnership documents as a follow-on investment within the private equity asset class, subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals within 12 months. May I have a motion, please?
So moved.
Thank you. May I have a second? We have a second.
Second.
Okay. Thank you. Okay. We have a motion and a second. Any further discussion before going to vote?
Chairman Becker, this is Dan
Yes,
Ocko,
go ahead.
if I may have a moment.
Sure.
I think our investment office has brought multiple successful companies that we've had a previous experience with, and we've had the company just preceding this. I think this is actually a very good company. I'm impressed with many of the things that they do. It was a good presentation, but in light of the performance, if they invested in 10 companies, and I realize it's early on, but one company can literally take the performance down to zero, I just don't think at this time I'm going to be voting yes. I would be happy to have the firm in the future, but at least for this vote, it's a no.
Okay. So noted. Thank you, Dan. Any further discussion or comments? Okay. Bill, maybe we have a roll call vote, please.
Okay. Chairman Becker.
Aye.
Senator DeSanto.
No.
Philman.
Aye.
Mr. Rocco.
No.
Treasurer Garrity.
I'll be voting no because I believe a number of the terms for this particular fund are not in the best interests of our beneficiaries. Thanks.
Okay, thank you. Ms. Marchowski.
No.
Mr. Jordan.
Aye.
Ms. Boyle. For Representative Schemmel.
Aye.
Ms. Soderberg.
Aye.
Secretary Thal. He's absent. Mr. Flanagan.
Aye.
Chairman Becker, we have 6 yes and 4 noes and 1 absent.
Okay. So the motion carries. Good.
Thank you.
Thank you very much.
Thank you.
Thank you.
Okay. Thanks again, PSG team, or TSG team, sorry.
Thank you.
Okay, again, be mindful of time here. Next presenter, we have the Erie's company coming up under board docs. 5F is in Frank. And we'll again ask Mike Elio from Stepstone to give us a portfolio fit review here. And then we'll ask the team to introduce themselves. Merritt, if you would start that up, that would be appreciated. So Mike, go ahead.
Sure, Jim. I'll keep it really short and really punchy. You have exposure to ASOF 1 through your Aries, Pennsylvania SMA. This would be continuing that exposure that you have in Fund 1, which has done incredibly well for you. You've also had the benefit of course, deploying that portfolio during a pandemic. So this will add to your distressed allocation within your credit portfolio, and will add, of course, to your North American exposure. But clearly, history is a sign that this GP has done well for you. Looking forward to continuing that and, of course, expanding that Ares PA relationship to accommodate this additional commitment to Ares Fund 2. So with that, I will pass that to Meredith. Meredith, good to see you.
Good to see everyone, and thank you so much for having us today. And this is one of our most important strategic partnerships across Ares. So we are very, very proud and happy to be here today. Myself and Miles Gilbert, who is on here, are in charge of the relationship management of this partnership. We're both partners at the firm and have been here for a very, very long time. Mike Arrighetti, I'll let you continue, and Scott and Craig and Indira, please go ahead. I think your mic's muted, Mike. No pun intended.
Thanks, Meredith. It wouldn't be an investment committee meeting in 2021 if somebody weren't muted. Thank you, everybody, for the time. I know that we are running a little short, so I will keep my comments brief to make sure that we get time to have the team walk through the strategy and positioning. But echo what Meredith said. I know I speak on behalf of all of my partners and colleagues here, and I say how grateful we are for the longstanding partnership that we have with all of you, and that partnership spans many years and many products. As we come today to talk about SOF2, the firm is, I believe, as well positioned as it has been in terms of its size, its capability set, the performance that we're delivering to our partners. And I think SOF, as Scott and Craig will get into, is really a shining example of durability of the types of strategies that we're able to execute on. This particular strategy is unique in that I think it really demonstrates the value of collaboration and the value that the platform can bring to a strategy like this in terms of advantage deal flow and information edge as we navigate volatile markets. And as Mike said, when you look at the historical performance of Fund 1 and the ability to invest for, through, and after the pandemic and deliver the returns they have, hope speaks volumes to the capability of the team, but also the value of the platform. Part of how we deliver the platform is really by investing in our culture. And I'm happy to have Indira Arrington here today to briefly talk about all of the investments that we're making across the impact spectrum at Erie. But I would say we have been investing quite significantly in ESG, DEI, and our corporate philanthropy for a number of years. We took the unique opportunity that was given to us through the pandemic to really reinforce who we were as a company and what our values and mission statement were. And that's resulted in a very broad-based, platform-wide investment in ESG and DEI, starting at the top of the house and really embedded into all of the investment and non-investment functions at the firm. Indira approaches her business with the same rigor, discipline, strategic framework that we do on the investment side of the house. And so is having a very significant impact as we continue to grow, scale, and globalize the business. So with that, I'm going to hand it off to Indira, I think starting on slide 5 of the presentation, just to give people a brief walk as to where we are on the DEI front before we hand it over to the team. And again, I'm grateful for the partnership and thank you for the time today. Indira?
Thank you so much, Mike. So as Mike said, we really view ESG and DEI as part of our corporate sustainability and responsible investment philosophy. To us, it's business critical. We truly believe that diverse perspectives are going to lead to better decision making, which leads to innovation and higher return on investment. So we are taking a truly transformational approach to DEI at Ares. Over the last several years, we have really been focused on embedding DEI into everything that we do. And if we go to the next slide, I'll read you, because I really think it's important, what our North Star is. Our DI framework and strategy aspires to harness the power of difference, to be a force for good, and contribute to the long-term success of Aries, the companies in which we invest, and the communities in which we operate. And our framework is set up to really ensure that we are touching all three through our pillars. It starts with our own people and culture. How do we attract, develop, engage, and advance our own people here at the firm? And that starts with embedding it in all of our human capital processes. Our business and investment process. As Mike mentioned, I truly believe that DEI needs to be run like any other business at Aries and any other function. So that means that we have to operationalize it. We have to have the infrastructure that'll truly allow us to set goals and hold ourselves accountable. And if we believe that DEI is good for Aries, then it should be good for all of our investments as well. So we have embarked on embedding DEI into all of our investment decision processes and our own procurement function. And then finally, our communities. We want to be a force for good. We want to lead by example. So we have strategically partnered with some industry partnerships and corporate partnerships to truly drive DEI and advance it within our industry. And last but not least, philanthropy. We are really focused on maximizing our impact from a philanthropic perspective with a view from a DEI perspective. At the core of our framework is to be data-driven, set KPIs, and hold ourselves accountable. With that, I'm going to turn it over to Scott and Craig.
Thanks, Indira. And if we can turn the page to page 8, that would be terrific. My name is Scott Graves. I'm the portfolio manager and the co-head of private equity at Aries. We are thrilled to be here, and thank you for your support in Fund 1. The Aries Special Opportunity Strategy is a non-controlled, primarily debt strategy. We target investing 80% of our capital in debt and 20% of our capital in equity. The first fund has performed very well. We're currently about 85% invested in the first fund with very strong returns. You can see here at the bottom of the page, we were at about a 65% gross and a 50% net, with no leverage as of the most recent reporting period. The fundraising on the second fund has been very strong. We are targeting $4 billion. We had a first close in October of $3.3 billion, and we are seeing strong demand to and through the end of year here, where we should get through our target and toward that hard cap. This is a strategy which is really designed to deliver consistent mid-teens net returns, but can substantially outperform in down cycles. We are doing this through debt securities that we tend to be higher up in the capital structure, more defensively oriented, and we have good defeasance of risk through coupon. Our current portfolio is yielding 10.2% across our debt portfolio and 8% overall. We do tend to recycle quite heavily and pivot between public and private markets. Over the life of a fund, you're going to see 40 to 50 total positions. So much more diversified than a classic private equity fund. And the velocity of our capital really creates shorter duration, which allows our LPs to create more decision-making for themselves. On a deployment basis, we've been very consistently deploying between $500 and $800 million a quarter. We'll talk about that a little bit. And really what we find most attractive is our competitive advantage. This is a business which sits inside our private equity functions. We tend to provide companies with private equity-like skill sets and advice, but on a non-controlled basis. We take advantage of integrated sourcing across our platform, leveraging both our large private equity functions as well as our large direct lending functions. In total, I think we have over 300 professionals out there sourcing across the middle market. and really using our private underwriting and diligence capabilities and our advantages created through industry and industry subsector across our footprint of 3,200 middle market companies and 920 sponsor relationships. Craig will talk about the team, but we're very proud of the team we've built. We've been investing together now over 5 years, deployed over $8 billion, and are very pleased with the competitive advantage that we have been able to generate. If we turn the page, I do want to emphasize that what we are doing is we are pivoting between private direct lending investments and public investments. Our core competency and our kind of more consistent deployment is clearly on the private side. Since inception in Fund 1, we've deployed about 2/3 of our capital in private investments. We tend to pivot to public investments in volatility and distressed. And it's this core competency in privates across our platform, which enables us to really be more of an all-weather deployment function for you and create those consistent returns across cycles with the ability to perform significantly better and create that vintage diversification, deploying more money into volatility when markets are weak, that we find very attractive to overall portfolios. Finally, if you turn the page to page 10, here you can see, how we go to access transactions. And again, we have about 750 professionals across the Ares platform. We cover 920 sponsor relationships across the platform. We have 3,200 middle market companies across industries, industry subsectors that we can leverage all of those ecosystems around management teams, corporate boards, and advisors there, giving us tremendous insight to the 60 different industries we cover. On the private market side, this is the more consistent area of our deployment. Our backlog, even today in relatively frothy markets, is very, very heavy. We have over 45 investments in our backlog today. And it's the thoroughness and the depth and breadth of this pipeline which enables us to really source differentiated opportunities and create that portfolio. We will pivot to public market investing when things are interesting. They are not interesting today from our lens, but in periods like COVID, or should we see volatility created by another distress cycle, this tends to be someplace where we can get real inefficient pricing and really exceed expectations from a risk and return perspective. So with that, I will hand it to my partner, Craig, who will walk you through the team and the market environment.
Thanks, Scott. Turning to page 11, Craig Snyder. I'm a partner and portfolio manager for the Special Opportunities Fund Strategies. As Scott said, as well as Mike, our team has been together for close to 5 years. And it's that continuity as our team has continued to kind of go to market, opportunities in both the public and private markets that has really, we think, helped drive alpha to this strategy. The day-to-day business for Special Opportunities is effectively run by myself, Scott, and Aaron. Aaron Rosen is co-portfolio manager as well with me. Scott, as he said, runs the global private equity business, joined by Felix Bernstein and Matt Underwood, who are our two other partners in the strategy. Our team is made up of 16 investment professionals. Again, the 5 partners on the top, and we have mid-level ranks from VP to principal, et cetera. And then we have a 2-year basically associate and analyst program. Our team has been together with minimal turnover. You'll obviously get some turnover on the associate ranks sometimes through when those 2-year programs hit maturity, but by and large, we've had very much a promotion from associate up. And to Indira's point, obviously continuing to strive to seek diversity across different candidates as we continue to kind of replenish the associate ranks and as our team grows. But by and large, we feel very confident with this strategy for Fund 1, which we've been able to execute, and now into Fund 2, By and large, this is the right amount of people to continue to kind of be surgical, still cast that wide net and create a differentiated kind of relative value, and create bilateral and differentiated investments that hopefully are different from other portfolios that you see. So very confident in the team. The team is basically set from a deal team perspective. A partner oversees a specific deal and is usually staffed with a vice president or principal, as well as various associates and analysts. Portfolio construction is basically taught on a team basis from the ground up, where everybody has a say in our structure. You can't really hide in our system, and everybody's always expected to contribute to the credit table and contribute ideas vis-a-vis our flat structure to continue that, kind of education and teaching mentality as you grow in your career. Candidly, I've derived a lot of benefits from the ASOF Investment Committee through my 5 years at Aries. As you'll see, it's 9 members, heads of businesses across the firm, from credit to direct lending. Obviously, Tony Ressler's on it, Bennett and David, who are co-founders and co-chairmen of the private equity business, as well as Matt Swertnia, myself, Scott, and Aaron. So a lot of benefits from that when we meet every Monday to go through a specific investment idea. Again, hitting to the point, we derive the ability of collaboration through the platform, the ability to leverage the direct lending relationships and the stability of that business and their access to over 850 sponsors on a global basis, as well as leveraging domain expertise on the private equity side. Turning to page 12, quickly on the market environment. This fund is a investment period. I think we've been able to show, we believe in SOF1, we can deploy capital consistently in both volatile markets like we saw in COVID throughout most of 2020, as well as more benign, highly frothy environments like we've seen for the better part of this year, where we focus primarily, if not all, on the private side. Scott and I like to say, as well as others, our crystal ball is no better than yours. What we are willing to make an assumption on is over the next 4 years, throughout this investment period, there will be pockets of volatility. There will be potentially another credit cycle. Don't know when, but volatility for us, at least in the medium to longer term, we think will be increased, which gives us the ability to kind of, again, use that relative value lens to our advantage. There's a lot of things to consider in the market today. A shock, tends to come when it's least expected, and that changes market psychology, which then takes risk prices that were usually on a highly valued trajectory lower. COVID is still front and center. The new variant and how that plays out and how that affects the recovery, as we've seen a ton of pent-up demand this year, as well as obviously earnings coming back to catch up with valuations. But, obviously something to watch very, very closely. And there's a lot of various different viewpoints on what this new variant will mean. There's bullish takes as well as bearish takes in terms of how that will play out. But, this is not going away. And we're obviously watching that, which dovetails into what's gone on effectively is over the last year and a half, we've seen so much pent-up demand, supply shortages, which obviously brings us to the biggest debate in the market today, we believe, which is the inflation debate, right? There was a camp 3, 4, 5 months ago where this was a transitory type phenomenon. I think the Fed has largely pivoted from that type of thinking, and they are trying to deal with that head on. And we've seen much more hawkish rhetoric from Chairman Powell, as well as other members of the Federal Reserve, where they need to, think about addressing inflation head on, right? Obviously, wage inflation feels like that's here to stay. The supply shortage has not been fixed yet. That feels like over time that will kind of come back in line. But both those two things are obviously two forces to deal with, specifically if the Fed will hike sooner than expected, and we're already starting to see the hike cycle kind of been brought forward from where we were even 6 months ago. So clearly that's something to watch, specifically as potentially rates could rise, as the market has been fueled by a low rate environment over the last 10 years, you could argue. But the accommodative policy, specifically in COVID, to kind of buoy markets, really kind of got us out of the depths, and remains to be seen if we continue in that trajectory and that pace. And then the last, few points you can read about, but there's a lot of other things. Obviously, the charged political and social environment feels like that's going to be around for a while. Housing prices are, kind of dovetail with the inflationary backdrop that I spoke about. Taxes, and where those could go from an increased perspective, and, a kind of hindrance on the consumer, which has really led the way out, over the last year. And the market structure has changed. We saw it last year when we did hit that pocket of volatility. It was an air pocket, and things repriced very, very quickly and dramatically. So these are all market considerations that we think about that could lead to volatility. But for us, again, the ability to deploy in both all weather environments, good and bad markets, we feel very confident about.
Thanks, Craig. So just to wrap up here, we couldn't be more excited about what the coming 4 years may bring for ASOF 2. We are off to a great start in ASOF 1. We think that our model here is competitively advantaged, and this is a very good strategy for what could be a volatile environment going forward. We thank you for your support of us in Fund 1 and your consideration in Fund 2.
Okay, any questions for the team? Okay. Katie, could you pull up the CIO slides here just to give the pacing perspective for this opportunity, which I neglected to do before the team started? If you can flip to the next slide, please. 2 slides forward. Yep, that one. So you can see the private credit allocation is relatively small to the target that we're trying to work towards. Again, out 10 years, we're trying to target 4%. So we're significantly underweight in this category. And again, we went out and tried to find, top hard to find managers, and we think we have one here for you today. And as the team has explained to you, we have that strategic partnership with them, which improves the economics. Just a reminder from our 2019 meeting when that strategic partnership was approved by this board. The next slide shows the pacing for the year, and you can see we are a little bit behind schedule here. Remember, we had a strategy that we moved to opportunistic fixed income last meeting that opened up this allocation so we can start allocating to these higher conviction opportunities. And then if you go to the next page, this was already covered by the GP. Spectacular returns on the first fund that we participated in with them. This will be the next one. And then finally, they have checked yes on all the transparency requests. And with that, Mr. Becker, ask you if you could.
Jim. If there are no questions for the Aries team, thank you, Aries team, for a very nice, good presentation. And we'll move to a motion. A motion is in order to recommend that the State Employees Retirement Board commit up to $100 million to Aries PA Opportunities Fund LP to be invested in Aries Special Opportunities Fund 2 LP and related co-investments, plus investment expenses and pro rata share of partnership operating expenses consistent with executed partnership documents as investments within the private credit asset class, subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals within 12 months. May I have a motion, please?
So moved.
Thank you. May I have a second, please?
I'll second it.
Thank you. We have a motion and a second. Any further discussion before going to vote? Okay. Hearing none. Bill, may we have a roll call vote, please?
Yes. Chairman Becker.
Aye.
Senator DeSanto.
I'll abstain due to a potential conflict.
Mr. Philman.
Aye.
Mr. Acco.
Aye.
Treasurer Garrity.
Aye.
Ms. Marchowski,
Aye.
Mr. Jordan,
Aye.
Ms. Boyle,
Aye.
Representative Schemmel, Ms. Soderberg,
Aye.
Secretary Thal is absent. Mr. Flanagan.
Aye.
Chairman, we have 9 yes and 1 abstention, 1 absent.
Great. Thank you. Motion passes.
Great. Okay, nice job, Bill. Thank you for that. We are starting to bite in, again, no pun, to lunchtime here. We do have one more opportunity and then a few housekeeping items after that. If you could turn to 5G and board docs, we're going to switch gears. We went through private equity and private credit. Now we're going to move into real estate. And if we could get the CIO slides, please. Katie, I'll do those in the beginning to set the stage. And go to 2 pages down, please. Again, we're trying to target 10 years out, 7% on our allocation. We're pretty close to that right now. And then this chart reads similar to the previous 2 asset classes, with the green line in the middle showing our current pacing updated target that Matt Ritter just went through before we got into these specific opportunities. So we're targeting $210 million a year out over the next 10 years to keep our allocation in line. And the next page will show you that this will be the first real estate investment opportunity that came to the board this year for various reasons we won't get into, but I guess you can say we saved the best till last, as the next page will show. Spectacular returns. This is a Pennsylvania-based firm that we have invested with before in a previous fund, and you can see that they have consistently, over the 3 funds that they invest in this strategy, they've done a very, very good job. And yep, we can go to the next page. First quartile rankings there over to the right you saw. And then again, we had full yeses to all the transparency items. So with that, Matt Ritter, if you would do a portfolio fit in an NEPC perspective on the manager, and then Allison and Jay, if you would have the team introduce themselves, that would be much appreciated. Go ahead, Matt.
Great. Thank you, Jim. So I'll keep my comments brief. I know we're running over on time here. But as Jim mentioned, LEM is a Pennsylvania-based firm and one that has performed well for SIRS in the past. But just as importantly, they're a manager that NEPC knows well and that we have high conviction in. I'll let LEM tell you more about their strategy, team, investment process, and all that. But just at a high level, they are focused on the multifamily or apartment sector within real estate, and they pursue a value-add investment strategy, which means they're buying existing properties and renovating or upgrading them. This is a segment of the real estate market, value-add multifamily that is, that NEPC has a very favorable view of today, and one that has been shown to be resilient throughout market environments. But this is not just about an allocation to the multifamily sector. As I said, we have high conviction in LEM as a manager and believe that they are a top manager within the sector. This is evidenced, as Jim just highlighted, by their top quartile performance in each of the last 3 funds. Again, being cognizant of time, I'll sort of just move on to the portfolio fit aspect, as Jim suggested. We believe that LEM will be a good and complementary fit to the existing real estate portfolio for SIRS for a few different reasons. First of all, SIRS is currently underweight multifamily relative to the Odyssey Index, which is the index for the portfolio. So we believe that a targeted investment in the multifamily sector is appropriate and should be beneficial to the plan. Secondly, as I mentioned, LEM pursues a value-add investment strategy. So a commitment to the fund would slightly increase the SERS allocation to value-add and opportunistic real estate, which is appropriate because SERS is currently underweight relative to the 55% target. And then lastly, just with regards to the pacing plan, as Jim mentioned, this will be the first commitment for 2021 within real estate. So if approved, would help to satisfy the pacing plan recommendations that were presented at the last investment committee meeting. So again, just in summary, this is a manager that we have high conviction in on an absolute basis, but also one that we think will fit very well into the SERS portfolio. And so with that, Jim, unless you have any other comments, I'll turn it over to the LEM team, Jay, Allison, Jennifer. It's all yours.
Yep, go ahead. Thank you.
Okay, thank you, Jim and Matt, for the kind words, and thanks for the consideration of an investment in LEM Multifamily Fund 6. I'm Jay Eisner, and I'm here today with Jen Clausen, who's a principal with LEM, and Allison Bradshaw, who's one of my partners, and I'm one of the founding partners of LEM. We started LEM in 2002, and our focus has always been on protecting investors' downside while building portfolios that generate consistent current cash flow, but that also have the opportunity to outperform on the upside. Everything we've done with respect to building our company, from developing our strategy to building out our team, our market selection, financing strategy, and on, is all centered on this idea of protecting investors' downside. Since 2010, we've been focused exclusively on acquiring well-located suburban multifamily properties in about 20 primary and secondary markets across the U.S. These properties are generally 10 to 30 years old, and we look for opportunities where we can add value by implementing a comprehensive renovation plan, but also by bringing in top quality management. Our typical renter has a household income of $35,000 to $75,000 per year, and what we try to do with every property is to deliver to them a like-new apartment experience at a very affordable price. Since we started this strategy, we've acquired over 100 properties and have renovated over 17,000 units. My mistake for not starting on the right slide. This is just a quick snapshot of LEM, but I've talked about most of that. So let's go to the next slide, please. These are the results for our 3 dedicated value-add multifamily funds. And we've performed at the top of our peer group and have far exceeded our original targeted returns, which were 12 to 15% net to investors in each of these funds. All 3 of the funds are ranked well into the top quartile by Preqin, and all place high in the Cambridge Value Add Benchmark Index. Our 2012 vintage Fund 3, which SERS was an early investor in and really helped us get started with this strategy, and we appreciate that very much, is fully realized now and delivered a net return to investors of 24.1% and a net multiple of 1.9 times. That placed it second among the 33 similar vintage funds tracked by Cambridge. Fund 4, which is a 2015 vintage fund, is 75% realized at this point. We'll wind up that fund next year. That fund is on pace to deliver a net 20% plus return to investors. And our 2018 vintage Fund 5, which we just finished investing and we've called all the capital in that fund, is currently ranked number 1 of its competitive set. Next slide, please. We believe our success in delivering these strong results over 10 plus years is centered on 3 key components. The first is the LEM team. We have a great team, very entrepreneurial in size and in approach, but with institutional experience across the team. Our investment platform is built around our acquisitions team, which has very deep market knowledge, and our robust asset management team that drives performance at the property every day. And those are 2 really, really important components for us. Second is our operating partner network, and this gives us a key advantage in sourcing deals, in executing our renovation plans, and in driving performance at the property level on a day-to-day basis. Key is how the LEM team integrates with our operating partners, and you'll hear more about that later in the presentation. And third is our fund size. We size our funds so that they're large enough to allow us to build a geographically diverse portfolio, but small enough to allow us to maintain a very disciplined and thoughtful investment selection process. And with that, I'm going to turn it over to Jen to take the next stage.
Thanks, Jay. I'm Jen Clausen, Head of Investor Relations at LEM and a principal at the firm. And thank you for the opportunity to the Pennsylvania SERS team and the NEPC team today. If you'd move to the next slide, please. LEM is a Pennsylvania-based manager, and we have a strong commitment to our state and our community. Our entire 19-person team is based here in our Philadelphia headquarters, and 80% of the team lives in Center City, Philadelphia, or its surrounding suburbs. 53% of our team attended Pennsylvania-based schools for either undergraduate or graduate programs. And we've made a commitment to the Philadelphia community through both philanthropy and educational partnerships, like the Drexel University Co-op program. Next slide, please. In 2020, we launched our ESG and DE&I programs. Our strategy is to invest in older, at-risk housing that would otherwise face obsolescence if not for new capital investment. We're providing a safe, clean, and contemporary home for the average working class American. Our investment strategy has some inherently positive impacts on ESG, and right now we're in the process of hiring an outside ESG consultant who will help us establish our near-term objectives, identify KPIs, and implement this across our due diligence process and portfolio. Next slide, please. We established a DE&I committee with the vision of fostering a corporate culture where differences in individuality is encouraged, understood, and valued, while also aiming to really connect with our community and connect them to our industry and our firm. We've implemented various initiatives to accomplish this goal around recruiting, retention, philanthropy, and community partnerships. As it stands today, 40% of the firm's leadership is female, and 42% of the overall team is either female or ethnically diverse. We've made some progress, but we recognize there's still much work to be done and look forward to identifying additional ways to create access to our community and our industry. Slide 12, please. Our investment thesis is based on the really strong imbalance between the various and persistent demand drivers for multifamily, especially in the more affordable product where we invest, and the long-term undersupply of housing. Both single and multifamily has been oversupplied for over the past decade. Given the cost to build and the scarcity of land, especially in the infill suburban markets where we invest, it's almost impossible to build new Class B multifamily product. From a demand perspective, there are just more people of all ages, demographics, and economic status that have elected to rent longer and more permanently. As an example, the younger generation has gotten started later and slower in their careers, which has delayed major life decisions like marriage and parenthood, and ultimately home purchases. Student debt, which is now over $1.7 trillion, has contributed to their inability to save and qualify for a home purchase. These long-term fundamentals are various and strong and are projected to continue over the long term. Now I will turn it over to Allison Bradshaw, a partner of LEM.
Thanks, Jen. If you could turn to slide 14, please. Perfect. As Jay mentioned, our focus is 100% on existing cash-flowing Class B multifamily assets, where we can create value through implementing better management and infusing capital into the properties to enhance amenities and unit interiors. Our goal is really to provide a like-new product at a price point that the median American household can afford. Turn to the next slide, please. A picture is worth 1,000 words. I'm going to roll through these pictures quickly. But this is a great example of a dated kitchen where we took what we call a ketchup and mustard first generation kitchen up to a modern finish. You turn to the next slide. With new cabinets, appliances, hardware, backsplash, fixtures, flooring, etc. On slide 17, this is what we love to see on potential acquisitions, a very underutilized pool area with an expansive footprint. And if you turn to the next slide, which gives us the ability to transform it into a resort-style pool deck. Flip to the next slide. In terms of other amenities, gyms are very important to residents. At this asset, we had a small existing gym and an ample clubhouse room. And as you can see on the following slide, we flipped the areas and created a best-in-class fitness center. Okay, flip to the next slide, please. In terms of our markets, we focus on roughly 20 markets across the country with populations of more than 1 million people that we feel are poised for outsized job and population growth. We're primarily focused on the first-ring suburbs that are infill with limited availability for new construction. 10 years ago, we recognized demographic shifts of people moving to many of our Sun Belt markets that had strong and growing employment drivers, but also offered an affordable lifestyle. Not only have these patterns held up, but frankly, over the last year and a half, the net migration patterns have only accelerated. You flip to the next slide, please. Each investment that we make is assessed based on a very disciplined investment criteria. And we will only really focus on deals that meet the vast majority of this 18-point checklist. This checklist is a way to ensure each deal has various ways to create value, providing us downside protection and also additional upside, whether through specific locational attributes, unique employment growth, or additional value add potential. We also have a very robust due diligence process that includes direct involvement in every deal by at least 2 members of our investment committee. Next slide, please. With COVID, we took a very compassionate approach with our resident base. We understood that this was an uncontrollable event, and we were really in this all together. Our goal throughout the pandemic has been to help keep our residents in their homes. For those residents whose employment was impacted by COVID, we worked to arrange flexible payment plans. We waived late fees. Our on-site teams assisted and continue to assist residents in completing applications for various rental assistance programs. We are working with everyone. It's been the extreme exception that when we've had to file an eviction, and that is when a resident will not work with us or is a clear bad actor. As a result, we've had very consistent occupancy levels and higher retention rates, and collections during the height of the pandemic were only marginally below historic standards. You flip to the next slide, please. There are 4 main drivers to our value creation. First, we work side by side our operating partners to find the best properties in the best locations. Because of their local presence, we often see off-market opportunities. The second is through property level improvements. We look for opportunities where we can physically transform a property from an outdated, tired asset to one with a contemporary, like-new look and feel, but still at an affordable rent. Third, we put in place on-site management teams that are focused on servicing our residents and maintaining a quality place for them to live. And lastly, we bring a deep capital markets knowledge and lending relationships to each investment, as well as our national broker relationships to the sales process. Next slide, please. A key area that we think sets us apart from our peers is how we integrate with our operating partners from the day we identify a potential acquisition and through the entire hold period. Our acquisitions officers have specific geographic coverage areas and are market experts in their own right. Each acquisitions person spends a tremendous amount of time in their markets working side by side our operating partners. Our asset management team is highly experienced and works on a day-to-day basis with our partners to drive execution, fine-tune business plans, and share best practices across the portfolio. Our team uses software that allows us to monitor performance on a daily basis with data that helps us to make real-time decisions and also supports our underwriting process. We believe our intense focus on continually improving our processes and approach has been one of the contributing factors to our solid return performance. That concludes our formal presentation. We want to thank you again for your support in Fund 3 and for your consideration in Fund 6.
Well, that was an incredibly well-done job getting through all that material in a small amount of time, so thank you for being mindful to that. Any questions from the group for the LEM team? Again, I guess another very fine presentation, left no questions unanswered, so Mr. Becker, please.
Mr. Nolan.
Yes,
yep.
Please.
Yes, Dan.
So I want to thank LEM for their significant and positive returns for all of the Commonwealth employees that are participants in the plan. We have a very diverse workforce in the Commonwealth of Pennsylvania, and we, from geographic to in every way. So and we've had the benefit in looking through all of your documents and looking at the returns and looking at several of your diversity efforts. And I would just want to try to encourage you to continue those efforts, and would hope that if you have ideas as an employer, we also have challenges in diversity and look at different approaches. So would encourage the opportunity potentially to meet with you in the future to try to see if there are additional ways we can do enhance diversity in all of our partners and ourselves. So I just want to thank you for your efforts and look forward to working with you.
Thanks, Dan.
Thank you.
Thank you.
Thank you, Dan. Any further questions before we go to the motion? Okay. A motion is in order to recommend that the State Employees Retirement Board commit up to $75 million to LEM Multifamily Fund 6 LP plus investment expenses and pro rata share of partnership operating expenses consistent with executed partnership documents as a follow-on investment within the real estate asset class, subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals within 12 months. May I have a motion, please?
So moved.
So moved. Thank you. May I have a second, please?
Second.
Second, thank you. We have a motion and a second. Any further discussion before going to vote? Okay, hearing none. Bill, may we have a roll call vote, please?
Yes. Chair Becker.
Aye.
Senator DeSanto.
Aye.
Mr. Philman.
Aye.
Rocco.
Aye.
Treasurer Garrity.
Aye.
Orchowski.
Aye.
Gordon.
Aye.
Ms. Boyle.
Aye.
Ms. Soderberg.
Aye.
Secretary Thal is absent. Mr. Flanagan.
Aye.
Chairman, we have 10 yes and 1 absent.
Great, thank you. The motion carries. Jim?
Okay. Very good. Okay, moving along, we just have a few short items. If you go to 5H, Jared Snyder and Meredith Jones, with assistance from Bill, have updated the investment policy statement to add a veteran preference to our emerging manager program. As I said, we just hired a veteran. We have another veteran on staff, Steve Belushi, that worked on the real estate opportunity that we just heard from. So we want to be supportive to those heroes. If anybody has any questions, we can address them now. Or Jared, do you have any high-level comments, being mindful of time here?
Nope. If they've had a chance to review the presentation, that has all the information in it.
Any questions for Jared? Okay.
Any questions?
Yeah, I think we move on from here.
Sure. So we do have a motion on that. Motion is in order to recommend that the State Employees Retirement Board approve the updates to the Emerging Investment Manager Program section of the Defined Benefit Plan's investment policy statement, which updates are provided in the attached meeting materials 5HDB Plan IPS EIM Update 12/7/21. May I have a motion, please?
So moved.
Thank you. May I have a second?
I'll second.
Thank you. We have a motion and a second. Any discussion before going to vote?
I just want to commend the staff for including veterans in the IPS. Appreciate it.
Great. Thank you, Treasurer. Okay. Bill, may we have a roll call vote, please?
Yes. Chair Becker.
Aye.
Mr. DeSanto.
Aye.
Ullman.
Aye.
Mr. Rocco.
Aye.
Treasurer Garrity.
Aye.
Ms. Marchowski.
This is Matt Lindsay on behalf of Senator Hughes. Tony needed to step away for a second. Aye.
Thank you. Mr. Jordan.
Aye.
Ms. Boyle.
Aye.
Ms. Soderberg.
Aye.
Secretary Thal is absent. Hannigan.
Aye.
Chairman, we have 10 yes, 1 absent.
Okay, great. That's a good change in the investment policy statement, so thank you for that. And the motion passes.
Okay, thank you, Chairman. And then moving on, 5I, this is more of a housekeeping item. Recall we collapsed the Defined Contribution Committee into other committees as appropriate, including the Investment Committee. So the investment policy statements for the Defined Contribution, Deferred Comp plans were updated, as well as the manager monitoring policy. Jared Snyder led this initiative and is here to answer any questions. It's all on board docs with the appropriate red line changes to the documents, and there's a motion for each. So if there's any questions for Jared or Bill here. Okay.
Jim, I just have one question for Jared. Good job, Jared. What I'm wondering about is on the manager monitoring policy. So first of all, I commend you and the staff for updating it. But what would you think about striking clauses 1 on 3 of that red line document, because the investment performance is public anyway? But if we were concerned about detailed reporting from the general investment consultant, maybe a compromise could be to make the list itself could be considered public, but that the detailed reporting would remain confidential. I don't know if anybody would be open to that.
Jared or Bill?
Treasurer. Yes, Treasurer, what specific section would you like to strike? We can use the defined benefit plan as an example for the manager monitoring policy.
It was clauses 1 and 3 on page 5. I lost the document because I lost connection here, but
okay. Yep.
But those were the two. But then we were thinking that maybe there would be a concern about the detailed reporting from the general investment consultant. So possibly the compromise could be that the list itself is considered public, because I think it is anyway. Because investment performance is public. So it's just a slight improvement to possibly to what you have.
Well, here's an option, if Jim's okay with it. I think an option is that we get together with and table this discussion, and then we'll get more details and discussion with Callan, and we have potentially another meeting in January, as well as for sure we have another one in February, and we can bring this back. It's not a immediate rush. It's not a time-sensitive matter. We'd rather do this right and make sure that we address the treasurer's concerns. So we can table this if Jim and Chairman Becker are okay with that.
Yeah. I think that sounds like a great idea. As long as it's not a time-sensitive thing, which I don't believe it is, why don't we do that and take it up at the next meeting?
So that'll be the three motions, Bill, we can hold on then.
We'll just hold all three for the next.
That's great. That is time safe. Thank you, Treasurer. That was very much appreciated with the way we're running behind here today. And then moving on to 5J in the meeting, we have an update. Jeff Meyer and Meredith Jones in our operations group updated the proxy voting policy in conjunction with our proxy voting consultant, ISS, and the materials are attached, pretty self-explanatory, but wanted to give you an opportunity to ask Jeff questions if needed. And again, that's a motion possible item as well.
Yeah, I'd like to comment if possible.
Okay. Please go, Senator.
Well, I'm going to be referencing the red line document. I don't know if anybody wants to pull that up, pages 9 and 10 of 50. And, I think the ESG commentary here is overly broad, and I really don't even understand what half of it means. And specifically, if you look on page 9, where it says, under extraordinary circumstances, SIRS will vote against or withhold regarding individual directors. It's about a third of the way down the page. I don't know if anybody's following along with me or not. But bullet point 1 says a material failure of governance, stewardship, risk oversight, or fiduciary responsibilities to the company, bribery, large or serial fines. And it goes on to say, and or poor risk oversight of environmental and social justice, social issues, including climate change. I mean, what does that even mean? And who is responsible for this document? Do we have an employee assigned to work with our proxy voting services to ensure that this 50-page document is followed?
Senator DeSanto, this is Jeff Meyer, the MD of Investment Operations, and yes, I am assigned to this document. And in conjunction with Meredith Jones, we work closely with the team of specialists at ISS that to provide these updates. And I mean, based on Mr. Nolan's introduction, I guess that the overview and that I was prepared to provide is going to be superseded by these questions and answers, which is fine by me. But with respect to the climate change, I need our friends from ISS to step in where I misspeak. And just for the record, we have Jacob Ferris, Ed Aspie.
Let me ask a question. I hate to interrupt, but can I ask a question? Because
absolutely,
I'm going to be a no on this. So I really don't need a detailed presentation of how somehow 50 pages of this is going to actually be implemented. But, when you look at this and you're talking about climate change, how many proxies do we vote on as SIRS on a yearly basis? Just a rough number. Does anybody know?
I think it's in the probably 8,000 or more. Meredith or ISS, could you guys?
Yeah, I mean, I'll accept that. That's fine. I don't even care if you're off 5,000 either way. How can we possibly, look at this stuff and be objective about it and make sure we're meeting our goals with this kind of document, especially when we, look at all of our own performance issues and everything. How can we possibly do it? So that's just my comment. on that. And I think just including a generic term like climate change and all those other things should all be just under material failures. There's no definition, material failure of governance, stewardship, risk oversight. How can you possibly objectively review that? That's my comment. And then, my second comment is on page 10. About a third of the way down there, it says, SIRS will generally vote against the chair of the nomination committee. You with me there? I know you're following along. So
Could somebody post this for us?
I'm sorry?
Could this be posted on our screens for us? It would help.
Mary, this is under consideration yet, so it's in your board docs only at this point.
Okay.
Okay.
Thank you.
And Mr. Ockel has his hand up as well. Senator DeSanto, unless you're still in the middle of your
I would
sentence.
just like to comment that I think there's a material error here under this section where it says SIRS will generally vote against the chair of a nomination committee. And if you look at bullet point 2, it says both genders are not represented on the board of a non-widely held company. And I mean, we all know there's more than 2 genders, so that should say all genders or list the 5 to 8 genders recognized by the government now. And that, in effect, would then change the 30% in the bullet point listed above. If there's 8 genders recognized by the government now, you can't have 8 30% equaling 100. I'm not sure what that number is, but we should at least look at that if it's 5 or 8 and change that 30% down to a reflective to 100% total.
Senator, that's a great point. If I could just make this one observation, this section that you're referencing is under non-U.S. companies. It's not domestic. And I'm not sure if the countries outside of the U.S. have the same number of various genders as you're referencing.
Well, I agree with you. That point's well noted. But I think if we're, striving to be, the best in class in a leadership role, we should probably reflect that.
Right.
Thank you. Thank you.
Just, Senator, if I could make one other response to your observations, and that is that particular section is more or less referencing the local laws and the continental European companies, where they, and that's why ISS recommended we make the change from female to underrepresented gender, so that in the event that we had a court consisting of all females, then we would need to get some males on there as well. And another point, this is all pursuant to a review that was done by the the Hampton Alexander review that was conducted in the UK and Ireland. So anyhow, thank you for your comments and your observations.
Jeff, could we table this till there's been a request in the boardroom to table this to the next meeting? For this needs some more discussion and review.
I think
absolutely, Jim. If the chairman and you want to table this, by all means, I'm prepared to table it. I guess the question I have for you, Jim, is it going to be at the January meeting or the February meeting?
Okay, Chair Becker has a couple.
February meeting.
Okay, Chair Becker has comments here.
I guess, thank you. Jeff, I would suggest that we table it. I think in light of Senator DeSanto's questions, comments, and some other comments that have come up, I think we should table it. Whether it's January or February doesn't make any difference to us, unless there's a time sensitivity on your end. Is there a particular time when we have to have this completed?
No, sir. I don't believe there's a time sensitivity. I guess that maybe if let me propose this. I know that the January meeting is early in the month. So if time permitting with the January meeting, we could hear all the other board members' concerns regarding the proposal, go back, make the adjustments based on what we hear at the January meeting, and then come back with a new improved product at the February meeting.
Good deal.
Is that
I
acceptable?
think that's very reasonable, and I think the board members should
Chairman
have
Becker?
sufficient time to make comments on this, and then we can address it and get back. So why don't
Absolutely.
we just shoot for February, and that would be fine.
Okay. And Dan, you have a quick comment? Go ahead. Mr. Alpo?
Rocco, I think you're up.
Dan, you're frozen at the moment, but there we go. Okay, you're unfrozen now. If you want to give it another shot.
Okay, thank you, Chairman Becker. And so I think there's one very important question that Senator DeSanto raised that we should try to get the most accurate answer right now to, which is, what is the provenance of this language? And so I would like to hear from ISS, and I'd like to hear from Mr. Meyer, because there were allegations that potentially it's important to understand what the provenance of this language is. And so I'd like to try to get that answer before we try to move on.
And Mr. Rocco, did you say provenance? In other words, what's behind the language we have in here?
Who wrote it? Is it ISS? Is it ISS standard language that they're suggesting to funds? Did we write this? I think it's just an important question.
In this particular case, these were recommendations made by ISS based on industry best practices. And we have gone back. I have gone back to ISS asking them to provide us with updates that would reflect industry best practices. Now, granted, it's clear that the board doesn't have to accept any of these best practices, but I think it's incumbent upon myself as well as my colleagues to provide the board with what's the industry best practices, and then the board, like Mr. DeSanto, raised his concerns about some of these issues, and we can strike them. If the board wants to do that, that's the board's prerogative.
And do we have ISS on the line? Do we have ISS on the line right here?
Yes, we do. And we can bring them back in February with us.
No, I think it's important just if ISS on the line right now, just to try to confirm Mr. Meyer's statement.
Yes, hi, this is Ed.
Pay them.
Okay.
Hello, hi, this is Ed Apsley with ISS. I can certainly chime in here. So I can confirm that Mr. Meyer's statement here that this is a collaboration approach. There is a set of best practice language that is based on regulatory environments within each global market, and this language reflects the best practice and regulations within the UK. So in these cases, when we're looking at adopting new language to make sure that we're just complying with what the market says and what the best practice is, what the investors themselves, what are coalescing around what's the best language, right? Not stock language, but like a language to address this issue. This is the best practice. I can say this is something that the vast majority of ISS clients leverage this same language because it is an agreed upon universal best approach on how to address this issue in that market.
And how many approximate clients does ISS have in the United States, and approximately how many public pension funds, if you have some ballpark numbers?
Custom research clients, which is essentially clients that have their own sort of bespoke approach. Is that what you're asking, or are you talking about the larger ISS universe? About 400, a little over 400 or so custom clients in the United States. I can't say exactly how many are pension offhand, but obviously we have a sizable number within ISS, and I would say this is a pretty standard approach.
Maybe you can get some numbers.
Chairman Becker, I think. Right. I think it was important to try to reframe the based on facts, which is this isn't some employee doing this. This is us trying to get the advice of, and is ISS the largest shareholder voting company?
We are the largest proxy advisory firm in the United
any other
States.
Shareholder service.
That's correct.
Right. So we don't have to adopt this advice, but we are getting advice from the largest provider in the country, what they believe to be the best practices. And so I think that's important to try to set the frame for this. If we want to discuss it future, that's fine. I do I do think it is important when we're talking about the environment and when we're talking about management risk. It is important to realize that potentially our fund has potentially lost, and I asked Jim for the number. I don't have the number, but this fund has potentially lost tens of millions of dollars investing in funds that invested in companies that did not manage environmental risk, and that's all in the last few years. So at the appropriate time, I'm happy to, when we discuss his future, I'm happy to ask that question to Jim. But I think there are significant fiduciary responsibilities and significant financial implications of investing in companies that don't know how to manage environmental risks. So with that, Mr. Chairman, I'll just turn it back to you, Chairman Becker.
Well, thank you. And clearly we have some responsibilities here, but I think based on what we've discussed, I think we need to table this for now and take a look at it and give us time to provide input to Jeff and the team, and then we can come back most likely at the February meeting. We could do that. Okay.
Thank you.
Okay, thank you, Chairman.
Good.
Okay, we have one final item here today. If you go to Board Docs 5K, Jared Snyder, in addition to Sergeant Beluca, our real estate analyst, previous Marine, they worked on an extension with the NEPC contract. Jared, if you want to just give a high-level overview of the terms and the period of time this will be covered. Thanks.
Yeah, absolutely, Jim. Thank you. Good afternoon, everyone. So this is an extension of the NEPC, our real estate consultant, for an 18-month period. The current contract is set to expire in June of 2022. So it's important to note that our contract with NEPC currently does have an inflation adjustment in it for January 1st, but we have worked with NEPC and they've been kind enough to grant us a freeze on the fee at the 2021 level. So starting January 1st, that inflation adjustment will not occur, and we'll simply just repeat the fee for 2021 throughout the 18-month period as well. So any questions?
And being an inflation, go ahead, Senator.
Yeah, just a comment. I think this would be an opportune time to rebid this work in the current environment and try to realize a savings instead of just extending the contract. So I will be a no on that. Thank you.
Okay. Thank you, sir.
Question?
Mary?
Yes, please.
My question is similar to the Senator's question. Why are we not putting this out for bid?
Bill?
Yeah, so I can answer that. I mean, we extended, we have extended contracts with our consultants in the past. They've been, performing well. The process that we go through is very extensive in regards to going out to the market, and it usually takes approximately 12 months to go through that process. And we thought right now, NEPC has been doing a great job. They're willing to extend the contract for the same costs that we are currently paying for all the same services. And there are some other things in the pipeline. Their contract expires on June 2022, so it's only 6 months away, or less than 6 months away. So we don't have enough time, I believe, to go through the full process. I think what we want to do is look at all of our consultant relationships, evaluate what the highest priority is with Jim and the members of this committee, and determine which ones we should go to market first. We extended the Stepstone contract, I believe, last April for 18 months, and that's due to expire in October of this coming up year. I mean, there's been some changes, at the investment office, and we're trying to conduct our business as streamlined, as efficient as possible. And we'll talk to this committee about going to the market. If anything, we should go to the market, with a private equity consultant, because that was extended, first. So.
Yeah, I'd like to comment on that. I think that's a great point. And just as a board member, it's hard for me to operate when this stuff is brought to me and say we don't have time to rebid it. I mean, we should have all this stuff calendared and start the rebidding process 6 months ago. If it takes a year, and so, granted, I know it's been a difficult year, and I know we've had some changes, but I just think we need to be constantly on our toes and looking at these things. And I'm not saying NEPC is doing a bad job. I just don't know, but I know the business world has changed dramatically in the last 18 months, and we should afford our plan members every opportunity we have to try to control our costs. So, thank you.
Yes, and Senator, very good points. And I'm asking just for a little bit of latitude there. As you know, we've had quite a bit of change in the CIO desk here over the last couple of years to add to this market environment. But we have taken initiatives within it. We have now we have a total fund analyst coming into the picture that's going to be able to help us do exactly what you're talking about, keep us organized, keep us ahead of the curve, and keep you all informed well ahead of time. So well taken. And we have, Mary, do you have a question there? I see your hand up.
Yes. So, the Senator is absolutely correct. There should be a timeline when we're mapping this out. And I understand there's been a lot of transition and a lot of craziness for a lot of various reasons over the last couple of years. But I know tomorrow we're going to have a presentation on our whole IT updates and what's happening there. And that was a situation where we had a contract that we were just extending without ever stepping back and saying, what's the end game? What are our goals? What's the timeline? And, we just can't afford to do that in today's world. How long are we extending? Are you proposing that we extend this contract?
We're proposing to extending the NEPC contract for 18 months. That will give us time, I believe, to, work with this committee to start, go to the market in regards to the private equity consultant consultant. That's set to expire in October, so we're short of time on that as well.
The good news here is for the board, if this contract just continued like it was structured to do, CPI's running it north of 5 or 6% right now, and they agreed to not apply that formula and hold their fees flat. Well, I'm transitioning into this role, and we're getting everything structured so we can do exactly what the Senator and Ms. Soderberg have referenced here and getting us online. And Chairman Philman has his hand up too.
Yeah, I do. I hear what we're saying, but let me say, I don't want to bid out every contract that we have. I agree that, for one thing, they were going to charge us for the cost of living or the CPI, whatever it is. And for us to go ahead and extend it on the same terms is obviously better than what we have. And my other issue is, once we go, we know very well how NEPC works. We're satisfied with the production. Just to say, let's go ahead and rebid every contract we had, that takes a hell of a long bit of time. Takes a heck of a lot of money on top of that. So, look, I'm not saying we should not look at every contract. I get that part. But right now, if we're being offered an opportunity to go ahead with the same rate that they gave us this year just to extend it, Jim is right. We've had some turnover in the CIO office that we didn't foresee coming when this was first instituted. So I think we should go ahead with this contract as it is right now. And I have no problem looking at all the other contracts, getting a calendar together to say this is the one that's coming up soon. And we can talk about the fact if they're not doing well, let's go ahead and bid out. But just to bid out everything, I have a real problem with that.
Bill, when did this contract initiated? When did it start?
Matt Ritter, if you're on, I think it started, they're usually 5-year contracts.
Okay, yeah.
Yeah, 5-year contracts.
It seems like it's been about 4 years ago, yeah. Because I think we are pretty much in agreement that NEPC has done a good job. We're pleased with the work that they have done. We will be getting, a break, as the chairman said, with the new contract. We're getting concession when we extend it. So I would agree. I think we should move forward with this and obviously keep looking at this. And I think having a timeline of when we should start looking at this, all the contracts, have that in place is definitely something we should be doing. And this year the past 2 years have been a little challenging, understood. But I think it is expensive to put things out for bid and to make a change in consultants too. So I think we should move forward with it. But open the floor to any further comments.
We'll commit to getting that timeline together for not just this contract, but all our contracts and obligations. So that's forthcoming.
Yes, sir.
Thank you, Glenn. Just a few short comments. Number one, the extensions, even though you extended for 18 months or whatever the time frame may be, you're not bound to keep it for that long. So that's one thing. The second thing is part of what you'll be hearing in the board governance committee and then being brought to the board are procedures on looking at our work plans. Each committee has a work plan. These sorts of things should be added to the work plan. And you'll see recommendations where there are not just, there'll be reviews of the contracts. Each of the contractors bring in the consultants, have discussions with them, discuss expectations. So there's a perfect process and tool to better manage this whole process.
That's helpful.
Yeah.
Thank you. So, good. Okay, any further questions, comments? Okay, so a motion is in order to recommend that the State Employees Retirement Board authorize an extension of the agreement between SERS and NEPC LLC for real estate consulting services for 18 months through December 1, 2023, with an amended fee schedule subject to successful completion of contract negotiations and execution and delivery of closing documents by all parties, including required Commonwealth legal approvals prior to its expiration. May I have a motion, please?
So moved.
Thank you. May I have a second?
I'll
have a second.
I'll second.
Okay, thank you, Blake. Okay, we have a motion and a second. Any further discussion before going to vote? Okay, hearing none. Bill, may we have a roll call vote, please?
Yes. Chair Becker.
Aye.
Senator DeSanto.
In the interest of being influenced by Chairman Philman, I'm going to change my vote to a yes and try to have some unity in the community. Thank you.
Thank you. Thank you. Mr. Philman.
Appreciative of the senator's comments, I vote aye.
Mr. Rocco.
Aye.
Treasurer Garrity.
This is Lloyd Ebright voting for the treasurer. Aye.
Thank you. Ms. Morchowski or Mr. Lindsay?
This is Matt Lindsay. Aye.
Mr. Jordan?
Aye.
Ms. Boyle?
Aye.
Ms. Soderberg?
Aye.
Secretary Thal? Absent? Flanagan?
Aye.
Chairman, we have 10 yes, 1 absent.
Great, thank you. Motion carries. Okay, Jim, we have any further work here?
Motion, but just to wrap up, informational items is you can see in 5L.
Your mic.
Sorry, my mic was off. Under 5L, in-board docs, the informational items, there's a group of items, 3 semi-annual in-depth reports, 1 from private equity, 1 from private credit, 1 for real estate, Second, I guess fourth, you'll see Meredith Jones and Jeff Meyer provided an update on the CSRS travel costs. It's a new process that we put in place. This is the first year, but of course that report has nothing but big fat zeros on it. There was no travel with the pandemic. And Jeff and Meredith also provided an update on the Funston recommendations, an update on that. And finally, one of our analysts, John Farrar, provided us the asset allocation report. So those are all under 5L, and feel free to ask for any explanations on that directly with our staff. Appreciate that. And that's all I have, Chairman.
Thank you. Just going through the agenda, there are no special presentations today. We are not planning to break for executive session. There are informational items in board docs for your review. If time for any additional committee questions, comments, concerns? Hearing none, may I have a motion to adjourn, please?
So moved.
Okay. Thank you. We are adjourned. The next committee meeting will be February 22nd, I believe. So, good. Thank you, everyone.